Welcome to this comprehensive preparation journey for the Certified Anti-Money Laundering Specialist exam. This course is designed to provide you with the technical knowledge and analytical mindset required to master the CAMS certification and apply these principles in a professional capacity. Earning your CAMS credential is a significant milestone that signals to the global financial community that you possess a rigorous understanding of anti-money laundering and counter-terrorist financing standards. This course offers a structured path through the complex landscape of international regulations, risk management frameworks, and investigative techniques. By following this curriculum, you will gain the confidence to navigate the exam's nuances and move beyond mere memorization toward true conceptual mastery. We have distilled the most critical information into a focused format that respects your time while ensuring no detail is overlooked. You will learn to identify vulnerabilities in various financial sectors, understand the mechanics of global standards, and implement effective compliance programs. Investing your time here is a commitment to your professional growth and to the integrity of the global financial system. In the chapters ahead, we will explore the fundamental risks and methods of money laundering, including the specific vulnerabilities found in correspondent banking and emerging crypto assets. We will then examine the international standards set by bodies like the FATF and the Wolfsberg Group, followed by a deep dive into the practicalities of building robust AML programs and conducting thorough customer due diligence. The final sections will focus on the mechanics of investigations, from identifying suspicious activity to handling law enforcement requests. Our plan is to build your knowledge layer by layer, starting with theory and moving toward practical application. This logical progression ensures that by the time you reach the final summary, you will be fully prepared for the challenges of the exam. I'm glad you're here. Let's get started. Welcome back. We are now ready to dig into the conceptual framework of money laundering. To understand how to prevent money laundering, we must first define what it actually is in a professional context. At its core, money laundering is the process of making illegally gained proceeds appear legal. When a criminal enterprise generates a profit from an underlying crime, such as drug trafficking, fraud, or tax evasion, that money is considered dirty because it cannot be introduced into the legitimate financial system without raising questions. The objective of the launderer is to move these funds through the financial system in a way that obscures their true origin, ownership, or control. By doing so, they hope to use the money as if it were derived from a legitimate source, thereby avoiding detection and subsequent legal consequences. This process is not merely a single act, but a series of transactions designed to break the audit trail. The primary motivations for money laundering extend beyond just hiding the source of funds. Criminals need to protect their wealth from seizure and ensure that they can enjoy the fruits of their labor without attracting the attention of law enforcement or tax authorities. Furthermore, successful laundering provides a stable source of capital that can be reinvested into further criminal activities, creating a self-sustaining cycle of illicit operations. If a criminal cannot spend or invest their money because it is clearly linked to a crime, the incentive to commit that crime is significantly diminished. Therefore, money laundering is often described as the lifeblood of organized crime, as it transforms static, unusable cash into dynamic, liquid assets. Understanding this motive helps us realize why AML controls are a required component of any modern financial infrastructure. The concept of the predicate offense is central to any legal definition of money laundering you will encounter during your exam preparation. A predicate offense is the underlying criminal activity that generated the illicit funds in the first place. In the past, many jurisdictions limited these offenses to drug trafficking, but modern international standards have expanded the scope to include a wide range of serious crimes. This list typically includes bribery, embezzlement, human trafficking, and increasingly, environmental crimes or cybercrime. From a compliance perspective, the specific nature of the predicate offense is secondary to the fact that the funds are the proceeds of crime. Your role as a professional is to identify the indicators that suggest funds are not originating from the stated legitimate business activities of the customer, regardless of which specific law was broken to obtain them. Disguising the illicit origins of funds requires a sophisticated understanding of how financial institutions operate. Criminals often exploit the very features of the global financial system that are designed to facilitate efficiency, such as wire transfers, shell companies, and complex corporate structures. By layering transactions across different jurisdictions or using intermediaries, they create a fog that makes it difficult for investigators to trace the path back to the original crime. For instance, a launderer might use a front company that appears to be a standard retail business to mingle illicit cash with legitimate revenue. This creates a plausible explanation for high volumes of cash deposits, making the illicit funds look like ordinary business proceeds. The complexity of these methods varies, but the goal remains the same: to sever the link between the crime and the criminal. We also need to consider the distinction between money laundering and terrorist financing, although they often share similar methods. While money laundering focuses on the origin of the funds, terrorist financing is primarily concerned with the destination or the intended use of the funds. It is entirely possible for legitimate funds, such as donations to a charity or salary from a legal job, to be used to support terrorist acts. However, when illicit funds are used for this purpose, the two concepts overlap significantly. In the context of your exam, you should keep in mind that many anti-money laundering regulations apply equally to countering the financing of terrorism. Both activities rely on the ability to move money through the financial system without triggering red flags, and both require the same level of scrutiny from compliance officers. Successful money laundering fundamentally relies on the corruption or exploitation of legitimate financial channels. If a financial institution has weak internal controls or a culture that prioritizes short-term profit over regulatory compliance, it becomes an attractive target for launderers. This is why the global community has moved toward a more standardized approach to regulation, ensuring that there are no weak links in the international financial chain. When you analyze a suspicious transaction, you're essentially looking for an absence of economic logic. If a transaction does not make sense given what you know about the customer's background or business model, it warrants further investigation. Identifying these anomalies is the primary defense we have against the integration of criminal wealth into the global economy, and it forms the basis of the topics we will cover in the coming lessons. I hope this provides a solid foundation for the more technical aspects of the laundering process that we will discuss next. See you in the next lecture. Welcome back. We are now ready to examine the mechanics of how illicit funds move through the financial system. To understand money laundering, we must look at it as a process rather than a single event. While every criminal enterprise is unique, the movement of funds generally follows a predictable sequence consisting of placement, layering, and integration. It is common to think of these as chronological steps, but in modern financial systems, they often overlap or happen simultaneously. Placement is the initial entry point where the dirty money first touch the formal financial sector. This is the most vulnerable stage for the launderer, because physical cash is difficult to move and easy to track. A classic example involves breaking down large amounts of cash into smaller, less conspicuous sums to deposit into various bank accounts or used to purchase monetary instruments like money orders. Once the funds have been successfully placed into the system, the launderer moves into the layering stage. The primary objective here is to obscure the audit trail by creating complex layers of financial transactions designed to hide the source and ownership of the funds. This might involve moving money between multiple accounts at different institutions, converting cash into different currencies, or trading in high-value assets. In the modern era, Layering often involves shell companies in jurisdictions with strict bank secrecy laws or the rapid movement of electronic funds across borders. By the time this stage is complete, the original source of the illicit funds should be nearly impossible for an investigator to trace back to the predicate crime. The final stage is integration, which gives the laundered money the appearance of being entirely legitimate. At this point, the funds are reintroduced into the economy in a way that provides a plausible explanation for their existence. Typical examples include investments in real estate, luxury assets, or legitimate business ventures that can produce clean dividends. For instance, a criminal might use an offshore company to loan funds to their own legitimate business, thereby allowing them to use the money openly. If the placement and layering stages were successful, the integrated funds will look no different from the capital of any honest entrepreneur. It is important to realize that professional money launderers are highly adaptable. While traditional placement might involve smuffing or structuring cash deposits, modern methods might leverage digital platforms or high-frequency trading. However, the underlying logic remains consistent throughout. Placement gets the money in, layering hides where it came from, and integration makes it usable. As a compliance professional, identifying these stages requires a holistic view of a customer's behavior rather than looking at an isolated transaction. We must pay attention to patterns that suggest money is being moved for no apparent economic or legal purpose, as these are the hallmarks of a laundering operation in progress. Understanding these three stages is fundamental because it informs where you place your controls and how you detect suspicious activity. If your institution is focused solely on cash transactions, you might miss the sophisticated layering occurring through wire transfers or corporate structures. Each stage presents different red flags and requires different investigative techniques to uncover. By recognizing whether a transaction looks like placement or layering, you can better articulate the risk in your reports to law enforcement. We will see these concepts resurface repeatedly as we look at specific industry vulnerabilities later. That covers the life cycle of laundered funds. I will see you in the next lecture. Welcome back. Today we will examine the repercussions of money laundering on a structural level, moving beyond individual transactions to observe how these activities degrade national economies and social fabrics. When money laundering occurs on a significant scale, it inevitably leads to increased volatility in exchange rates and interest rates. This happens because the movement of illicit funds is not driven by economic fundamentals, such as productivity or market demand, but by the necessity of avoiding detection. If a large volume of capital suddenly exits a developing economy because the launderers perceive a change in law enforcement scrutiny, the resulting capital flight can destabilize the local currency. This unpredictability makes it difficult for legitimate businesses to plan for the future, as their cost of capital and purchasing power becomes subject to the whims of criminal actors. Policymakers find themselves in a difficult position, as traditional monetary tools often fail to influence these irrational and hidden financial flows. Another detrimental macroeconomic effect is the unfair competition that arises when front companies are used to integrate illicit funds. These businesses often offer goods or services at prices well below market value because their primary goal is not profit maximization, but rather the recycling of dirty money. A legitimate business owner cannot compete with an entity that has a subsidized, tax-free source of capital and does not need to turn a profit to survive. Over time, these front companies crowd out honest competitors, leading to a monopolistic environment where the local economy becomes increasingly dependent on criminal enterprises. Once legitimate industries are hollowed out, the economic resilience of the entire region is compromised. Money laundering also results in a significant loss of tax revenue for governments, which diminishes the quality and availability of public services. Since illicit funds are by definition hidden from the state, they do not contribute to the fiscal pool used for infrastructure, education, or healthcare. This creates a vicious cycle where the government must either increase the tax burden on the shrinking pool of legitimate taxpayers or reduce public spending. In many cases, the corruption inherently linked to money laundering further worsens this by diverting existing public funds into the pockets of officials who facilitate the laundering process. The weakening of these public institutions reduces the state's capacity to uphold the rule of law and protect its citizens. The social consequences are equally severe, as money laundering effectively finances and incentivizes further criminal activity. By providing a mechanism for criminals to enjoy the fruits of their labor, the financial system inadvertently validates illegal business models like human trafficking, drug smuggling, and arms dealing. When a society sees that crime pays and that the wealthy can bypass the law through sophisticated financial engineering, the moral incentive for the general population to remain law-abiding declines. This erosion of social trust is difficult to quantify, but has a profound impact on the long-term stability of a nation. It creates a culture of cynicism where the rule of law is seen as a suggestion rather than a requirement. Furthermore, nations that are perceived as being soft on money laundering or high risk for financial crime face reputational damage that restricts their access to the global financial system. International banks may decide to de-risk by terminating correspondent banking relationships with institutions in these jurisdictions to avoid regulatory fines. This isolation makes it harder for the average citizen to engage in international trade or receive remittances from family members working abroad. The cost of doing business increases for everyone in the country, even those who have no connection to criminal activity. In this way, the actions of a few launderers can lead to a systemic economic slowdown that affects the entire population's standard of living. I hope this provides a clear understanding of why anti-money laundering efforts are not just about compliance, but about protecting the integrity of our global society. Until next time, welcome back. We are now going to examine the specific structural weaknesses that make correspondent banking such a high-risk area for financial institutions. Correspondent banking is essentially the provision of banking services by one bank, often referred to as the correspondent, to another bank, known as the respondent. This relationship allows the respondent bank to conduct business and provide services to its own customers in jurisdictions where it does not have a physical presence. The most significant vulnerability here is that the correspondent bank processes transactions for people or entities it has never met and for whom it has no primary documentation. The correspondent bank is effectively relying on the respondent bank's due diligence and internal controls, creating a significant layer of separation between the financial institution and the ultimate originator of the funds. This distance is a natural environment for illicit actors to move money across borders with reduced visibility. Nested correspondent banking takes this complexity a step further and introduces even more risk into the system. In a nested relationship, a respondent bank provides its own correspondent banking services to other smaller or regional financial institutions. When the primary correspondent bank processes a transaction, it may be looking at the activity of a customer of the respondent. This layering makes it nearly impossible for the primary correspondent to accurately assess the risk profile of the underlying transactions. If the respondent bank does not have robust oversight of its own downstream clients, the primary correspondent becomes a blind conduit for potentially laundered money. This cascading lack of transparency is exactly what anti-money laundering regulations aim to mitigate through strict oversight requirements. Another specific vulnerability arrives in the form of payable through accounts, commonly referred to as PDAs. In a PDA arrangement, the respondent bank provides its own customers with direct access to the correspondent bank's accounts through checks, debit cards, or wire transfers. This effectively allows the respondent bank's customers to operate as if they were direct customers of the correspondent bank, despite having undergone no onboarding or verification by that institution, because these customers can execute transactions directly through the account. The speed of movement often outpaces the correspondent bank's ability to monitor for suspicious patterns in real time. Without rigorous controls, PDAs can be exploited to bypass the traditional geographical boundaries that usually limit money laundering operations. The sheer volume of transactions processed through correspondent accounts presents another practical challenge for risk management. Correspondent accounts often aggregate thousands of individual transactions into a single daily settlement or a handful of bulk wires. Within these massive flows of capital, a sophisticated money launderer can hide smaller, illicit transactions that appear insignificant relative to the total volume. Even with automated monitoring systems, the lack of granular data regarding the ultimate beneficiary in these bulk movements makes it difficult to detect anomalies. The correspondent bank is often forced to rely on retrospective analysis, which means the funds have likely already been moved and integrated by the time a red flag is raised. The jurisdictional risk associated with the respondent bank also plays a critical role in the vulnerability of the correspondent relationship. If the respondent bank is located in a country with weak AML regulations or a high degree of corruption, the risk that the account will be used for illicit purposes increases exponentially. This is particularly problematic when the respondent bank is a shell bank, which is a bank that has no physical presence in any country and is not part of a regulated financial group. International standards strictly prohibit dealing with shell banks, but the risk remains that a respondent bank might inadvertently or otherwise provide services to one. Understanding the regulatory environment of the respondent bank is a mandatory component of managing the vulnerabilities inherent in these cross-border relationships. Finally, the lack of information sharing between institutions creates a functional gap that exploiters of the system are keen to utilize. When a correspondent bank identifies a suspicious transaction, it may not have the legal or operational framework to ask the respondent bank for detailed information about the underlying customer without triggering, tipping off concerns, or violating local privacy laws. This information asymmetry ensures that the correspondent bank is often operating with one hand tied behind its back. Effective risk mitigation in this area requires a proactive approach to due diligence that goes beyond mere checkbox exercises. It involves a deep understanding of the respondent's business model, their customer base, and the quality of their own internal compliance program to ensure the relationship remains a viable channel for legitimate commerce. I hope this provided a clear view of how correspondent banking can be manipulated. See you in the next lecture. Welcome back. In this session, we will examine the vulnerabilities and regulatory landscapes of non-bank financial institutions, which often face different risks than traditional commercial banks. While we often focus on banking, non-bank financial institutions, or NBFIs, represent a significant portion of the global financial system and present unique opportunities for money laundering. Casinos are a prime example of this risk because they operate with high volumes of cash and offer a variety of ways to disguise the origin of funds. A common method involves a client purchasing chips with illicit cash, engaging in minimal gambling activity, and then redeeming those chips for a check or a wire transfer. This process effectively converts dirty cash into a payment from a legitimate, regulated business, which can then be deposited into a bank account with much less scrutiny. Furthermore, casinos often provide quasi-banking services, such as accounts where funds can be held or transferred, further complicating the audit trail for law enforcement. Money service businesses, commonly known as MSBs, are another category of NBIs that require rigorous oversight due to their accessibility and the speed of their transactions. These entities include currency exchangers, check cashers, and money transmitters who often operate in many jurisdictions with varying levels of regulatory maturity. The primary risk here is the ability to move funds across borders without the same level of customer due diligence typically found in a retail bank. Structuring, or smuffing, is particularly prevalent in MSBs, where individuals make multiple small transfers to stay below reporting thresholds. Because MSBs often rely on agents who may not be as well trained as bank employees, they become preferred targets for those looking to bypass global anti-money laundering controls. The insurance sector also presents specific vulnerabilities, particularly in the life insurance and annuity markets. Unlike property or casualty insurance, life insurance products often have a cash value or can be used as an investment vehicle. A money launderer might purchase a high-value life insurance policy with illicit funds and then cancel it shortly after during the free look period. Even if a surrender penalty is applied, the launderer receives a clean check from a reputable insurance company, achieving the goal of layering. Additionally, policyholders may take out loans against the cash value of their policies, creating another layer of financial complexity that obscures the original source of the wealth. Dealers in high-value goods, such as precious metals and stones, function as NBFIs because their products are highly liquid and hold their value well over time. These items are easily transportable, can be traded internationally with relative anonymity, and are often accepted as a form of payment in underground economies. The challenge for compliance in this sector is the lack of a centralized clearing system, making it difficult to track the movement of goods and the associated payments. Regulatory frameworks often require these dealers to implement programs similar to those of banks. Yet the informal nature of some trades remains a significant loophole. Without a physical paper trail or electronic footprint, these assets can be moved through various jurisdictions with minimal risk of detection. To manage these risks, regulators have increasingly expanded the definition of obligated entities to include these non-bank sectors, requiring them to adhere to standard AML protocols. This includes performing customer due diligence, maintaining records of large transactions, and filing suspicious activity reports when behavior deviates from the expected norm. However, the diversity of these businesses means that a one-size-fits-all approach to compliance is rarely effective. A casino's risk profile is fundamentally different from that of an insurance broker or a currency exchange. Therefore, understanding the specific operational mechanics of each NBFI is crucial for any compliance professional aiming to identify and mitigate the risks of financial crime in these specialized environments. I hope this provides a clearer picture of why these entities are so attractive to those attempting to launder money. Until next time, welcome back. We're going to look at the intersection of cryptography and financial crime. As the financial landscape evolves, money laundering methods shift from traditional banking structures toward decentralized and non-obvious technologies. We must understand that while the underlying goal of a criminal remains the same, converting illicit proceeds into legitimate-looking assets, the mechanisms for doing so have become increasingly sophisticated. Crypto assets, often referred to as virtual currencies, represent a significant shift because they allow for the transfer of value without the necessity of a traditional financial intermediary. This disintermediation is the primary driver of risk in the emerging financial ecosystem. When we remove the centralized gatekeeper, we also remove the traditional point of control where anti-money laundering protocols are typically enforced. Consequently, we must analyze how these digital assets are utilized to bypass standard regulatory frameworks. The inherent architecture of many cryptocurrencies provides a level of pseudonymity that traditional bank accounts cannot match. While a blockchain acts as a public ledger, it does not record the real-world identity of the person initiating a transaction, but rather an alphanumeric address. This creates a hurdle for investigators who must link these digital footprints to specific individuals or entities. Criminals exploit this by using various obfuscation techniques, such as mixing services or tumblers, which blend potentially identifiable cryptocurrency funds with large pools of other funds. This process effectively breaks the trail back to the fund's original source, making it difficult to prove a connection to a predicate crime. We should view these services as the digital equivalent of a professional money launderer who layer transactions through multiple shell companies. Beyond simple transfers, we're seeing the rise of more advanced peer-to-peer financial technologies that further complicate the regulatory task. Decentralized finance, or DeFi, allows users to engage in lending, borrowing, and trading through automated smart contracts rather than through a regulated exchange. These protocols often lack any form of know-your-customer onboarding, which creates a significant vulnerability for the global financial system. If a criminal can move funds into a DeFi protocol, they can leverage those assets to generate yields or swap them for other tokens, all while remaining outside the view of traditional compliance officers. This evolution means that the risk is no longer confined to a single asset class, but is systemic across an entire decentralized ecosystem. Another emerging risk involves the use of anonymity-enhanced cryptocurrencies, often called privacy coins. Unlike Bitcoin, which has a transparent ledger, these assets use cryptographic techniques like ring signatures or zero-knowledge proofs to hide the sender, recipient, and transaction amount. From a compliance perspective, these assets represent a high-risk category because they are designed specifically to prevent the type of transparency that AML regulations require. When an institution encounters a customer moving funds from a privacy-centric wallet, it is almost impossible to perform effective source of wealth or source of funds verification. We must therefore assess the risk of a client, not just based on who they are, but on the technical characteristics of the assets they hold. We also need to consider the role of prepaid cards and their integration with digital asset ecosystems. Many crypto platforms now offer debit cards that allow users to spend their digital holdings at any merchant that accepts traditional payment networks. These cards act as a bridge between the virtual world and the physical economy, providing a streamlined method for the integration stage of money laundering. If the initial onboarding process at the crypto exchange was weak, these cards allow illicit value to enter the legitimate stream of commerce with very little friction. As compliance professionals, we must be aware of how these hybrid products can be used to circumvent cash withdrawal limits and reporting thresholds. The rapid development of non-fungible tokens, or NFTs, has introduced another layer of complexity to the laundering landscape. Because NFTs represent unique digital items and their value is often subjective, they can be used for wash trading to create the appearance of legitimate profit. A criminal can purchase an NFT from themselves using a different wallet, setting a high price floor, and essentially laundering the funds through a fake sale. This mirrors the traditional method of using high-value art to hide the movement of wealth, but it happens at a much higher velocity. Understanding these patterns is essential for identifying suspicious activity that does not fit the profile of a standard retail investor. I'll see you in the next lecture. Welcome back. It is time to solidify our knowledge with a short quiz regarding the fundamental mechanics of money laundering and the vulnerabilities inherent in modern financial systems. A financial institution is reviewing its risk profile and identifies several concerns regarding the flow of illicit funds through its accounts. Which of the following best describes the stage of money laundering where funds are moved through various accounts to distance them from their criminal source? Additionally, identify which service is most vulnerable to being used as a conduit for large-scale laundering across international borders without the host bank having a direct relationship with the ultimate customers. A. Placement and private banking. B. Layering and correspondent banking. C. Integration and trade-based money laundering. D. Layering and crypto asset exchanges. Please pause the video now to consider the mechanics of these processes before we proceed to the explanation. The correct answer is B, layering and correspondent banking. This question requires you to distinguish between the three stages of money laundering and the specific vulnerabilities of institutional banking services. The layering stage is specifically designed to create complex layers of financial transactions to separate the illicit proceeds from their source, often involving multiple transfers or moving funds across borders. While crypto assets do present emerging risks, the classical definition of a conduit for large international flows without a direct customer relationship explicitly describes correspondent banking. In a correspondent relationship, the correspondent bank provides services to a respondent bank, meaning the correspondent bank often has no direct verification of the respondent bank's underlying customers. This lack of transparency is why the FATF and other regulatory bodies highlight correspondent banking as a high-risk area for layering activities. Incorrect options like placement refer to the initial entry of cash into the system, while integration refers to the final stage where funds reappear as legitimate wealth. Private banking is a risk, but it typically involves a direct relationship with the client, unlike the arm's-length nature of correspondent banking. I look forward to seeing you in the next lecture. Welcome back. We are shifting our focus toward the international frameworks that dictate how individual nations and financial institutions structure their anti-money laundering efforts. At the center of this global architecture sits the Financial Action Task Force, commonly referred to as the FATF. Established in 1989 during the G7 summit in Paris, the FATF was initially a response to the growing threat of drug-related money laundering. It began as an intergovernmental body designed to set standards and promote the effective implementation of legal, regulatory, and operational measures. Over time, its scope expanded significantly, notably in 2001 when it began addressing the financing of terrorism following the attacks in the United States. Later, the mandate grew again to encompass the financing of the proliferation of weapons of mass destruction. The FATF functions not as a legislative body with the power to arrest individuals, but as a policy-making organization that exerts influence through peer pressure and global consensus. Its primary mandate is to generate the necessary political will to bring about national legislative and regulatory reforms in these specific areas. It currently consists of over 30 member jurisdictions and several regional organizations, such as the European Commission and the Gulf Cooperation Council. By setting high-level standards, the FATF ensures that there is a synchronized global front against financial crime, preventing criminals from simply moving their operations to the jurisdiction with the weakest oversight. You should view the FATF as the architect of the rules that your own local regulator eventually enforces through domestic law. One of the core objectives of the FATF is the continuous monitoring of its members' progress in implementing the necessary measures. This is achieved through a rigorous system of mutual evaluations where member countries audit each other to ensure compliance with the established standards. Beyond monitoring, the FATF also identifies and analyzes various money laundering and terrorist financing techniques, which are often published as typology reports. These reports provide the empirical evidence needed to update the standards as criminal methods evolve. If a country fails to meet these standards or lacks a sufficient legal framework, the FATF can effectively isolate them by placing them on public lists. This public signaling serves as a warning to the global financial community that doing business with those jurisdictions carries a heightened risk. The FATF also plays a critical role in promoting the adoption of its recommendations by non-member countries. While the direct membership is relatively small compared to the total number of countries in the world, the reach of the FATF is extended through FATF-style regional bodies, or FSRBs. These regional bodies cover virtually every part of the globe ensuring that the standards are applied universally regardless of whether a country is a direct member of the FATF itself. This global network is essential because money moves across borders almost instantaneously, and a single weak link in the chain can compromise the entire international financial system. Therefore, the FATF's work is less about enforcing specific laws and more about creating a ubiquitous environment where illicit funds find no place to hide. Understanding the history and mandate of the FATF is foundational for the CAMS exam because it explains the why behind most compliance procedures you encounter in a professional capacity. When you see a change in your local AML laws, it is almost certainly a downstream effect of a decision made at the FATF level. The organization operates on a multi-year mandate that is periodically reviewed and renewed by its ministers, ensuring it remains relevant to the current geofinancial climate. Your task as a compliance professional is to understand these high-level objectives so you can better interpret how they apply to the daily operations of the financial institution. We will build on this by looking at the specific recommendations in the next part of the course. I'll see you in the next lecture. Welcome back. In this session, we're going to look at the structural foundation of international anti-money laundering efforts, specifically focusing on the FATF 40 recommendations. The Financial Action Task Force established these 40 recommendations as a comprehensive framework intended to be implemented by all countries to combat money laundering and terrorist financing. You should view these not as a rigid set of rules, but as an international standard that provides a blueprint for effective legal, regulatory, and operational measures. When we examine the 40 recommendations, we are essentially looking at the global baseline for what a functional AML regime must look like. They cover everything from the criminalization of money laundering to the transparency of legal persons and international cooperation. While each nation has the autonomy to adapt these standards to its unique legal system, the core requirements remain constant across borders. Understanding the structure is vital for the CAMS exam because it allows you to see how individual institutional policies connect back to global mandates. The recommendations are organized into several key themes, and the first major area involves the implementation of a risk-based approach. This concept is central to the entire FATF philosophy, requiring countries to identify, assess, and understand their specific money laundering and terrorist financing risks. Once these risks are understood, countries must apply resources in a way that ensures the greatest risks receive the highest level of attention. Instead of treating every transaction or client the same, the risk-based approach allows for a flexible and efficient deployment of compliance measures. This means that financial institutions are expected to perform more rigorous due diligence on high-risk clients while applying simplified measures to those deemed low risk. For the purposes of the exam, you need to remember that the risk-based approach is the first recommendation and serves as the cornerstone for all subsequent actions. Another critical section of the recommendations focuses on the legal systems and the powers of competent authorities to investigate and prosecute financial crimes. The FATF mandates that countries must criminalize money laundering based on the Vienna Convention and the Palermo Convention, ensuring a wide range of predicate offenses. This section also outlines the necessity for countries to have effective confiscation and provisional measures to freeze or seize assets derived from criminal activity. It is not enough to simply have laws on the books. The recommendations insist that law enforcement and regulatory agencies have the necessary investigative tools to follow the money. This includes the ability to obtain financial records through subpoenas or search warrants and the power to use undercover operations or intercepted communications. Without these legislative powers, the regulatory framework would lack the teeth necessary to deter sophisticated criminal networks. Financial and non-financial businesses are also heavily regulated under the 40 recommendations through specific preventive measures. This includes mandates for customer due diligence, record keeping, and the reporting of suspicious transactions. Financial institutions are required to verify the identity of their customers and the beneficial owners of accounts to prevent anonymous participation in the financial system. The recommendations also extend these requirements to designated non-financial businesses and professions, such as casinos, real estate agents, and lawyers, when they engage in specific high-risk activities. For instance, if a lawyer is handling a real estate transaction on behalf of a client, they must adhere to many of the same AML standards that a bank would. By broadening the scope beyond traditional banking, the FATF aims to close the gaps that money launderers typically exploit to layer their funds. Furthermore, the recommendations address the transparency and beneficial ownership of legal persons and arrangements, such as corporations and trusts. The goal here is to ensure that competent authorities can access adequate, accurate, and timely information on the real human beings who own or control these legal entities. Money launderers frequently use shell companies and complex corporate structures to hide their identities, so transparency in this area is a high priority for the FATF. The standards require countries to take measures to prevent the misuse of legal persons, which might include maintaining a central registry of beneficial owners. This focus on looking through the corporate veil is a recurring theme in global AML regulations and is something you will encounter frequently in professional practice. If you can identify who truly benefits from a transaction, you can much more effectively assess the potential for illicit activity. Finally, the recommendations emphasize the importance of international cooperation, given that financial crime often crosses many national borders. Since money laundering is frequently a transnational offense, the FATF expects countries to provide the widest possible range of mutual legal assistance and extradite individuals accused of financial crimes. This international cooperation extends to the exchange of information between financial intelligence units and law enforcement agencies across different jurisdictions. The 40 recommendations facilitate a network where information can flow as freely as the capital being moved by criminals, creating a more hostile environment for money laundering globally. It is important to recognize that no country is an island in the financial world. The effectiveness of one nation's AML regime is often dependent on the cooperation of its neighbors. By adhering to these collective standards, the global community creates a unified front against financial crime. This concludes our overview of the FATF 40 recommendations. See you in the next lecture. Welcome back. The Financial Action Task Force does more than just publish a list of recommendations. It actively monitors how jurisdictions implement these standards through a mechanism known as the mutual evaluation process. This isn't a mere suggestion or a passive observation of local laws, but rather an intensive, high-pressure peer review system where several countries examine one another. The objective is to ensure that every member state maintains a consistent level of rigor in their fight against financial crime. Within this process, we distinguish between two primary benchmarks: technical compliance and effectiveness. Technical compliance looks at whether the necessary laws and regulations exist on paper, while effectiveness measures how well those systems actually work in practice. Understanding this distinction is crucial for the CAMS exam because it reflects the shift from a check-the-box mentality to a results-oriented framework. When we talk about technical compliance, we are essentially looking at the legal architecture of a country. FATF assessors evaluate the jurisdiction against each of the 40 recommendations to see if the specific legal requirements are codified in the local legislative framework. For example, if a recommendation requires countries to criminalize the financing of terrorism, the assessors will check if the penal code explicitly contains such a provision. They analyze the powers of the Financial Intelligence Unit, the legal obligations for suspicious activity reporting, and the regulatory oversight of non-bank financial institutions. If the laws are in place and meet the criteria of the recommendations, the country is rated as compliant or largely compliant. However, Having a law on the books does not necessarily mean the financial system is protected, which is why technical compliance is only half of the story. Effectiveness is the second and arguably more difficult pillar of the mutual evaluation process. This is assessed through 11 immediate outcomes, which serve as key goals that an effective AML/CFT system should achieve. While technical compliance asks, is there a law? Effectiveness asks, is the law stopping money laundering? Assessors look for empirical evidence, such as the number of successful prosecutions, the amount of criminal assets seized, and the speed at which the government responds to international requests for assistance. A country might have perfect laws, but fail its evaluation if its judges are untrained or if its police force lacks the resources to investigate complex financial structures. This outcome-based evaluation ensures that jurisdictions cannot simply provide a veneer of compliance while allowing illicit funds to flow through their borders unchecked. The actual process of a mutual evaluation is divided into several distinct phases, beginning with the preparatory stage. During this time, the country under review must provide documented evidence of its technical compliance and its own internal assessment of risks. This is followed by an on-site visit where a team of experts, usually comprising legal, financial, and law enforcement professionals from other member countries, interviews government officials and private sector representatives. These interviews are not informal chats. They are rigorous inquiries designed to verify the data provided in the preliminary reports. The private sector's role is particularly important here, as assessors will talk to compliance officers at banks to see if they actually understand and implement the risk-based approach. The quality of these interactions often dictates the final tone of the evaluation report. Once the on-site visit concludes, the assessment team drafts a mutual evaluation report, often referred to as an MER. This document provides a detailed analysis of the country's situation, highlighting both strengths and significant deficiencies. This draft undergoes a period of review and challenge, where the country can dispute findings if they believe the assessors misunderstood a particular legal mechanism or ignored specific data points. Finally, the report is discussed and defended during a FATF plenary meeting, where all member jurisdictions must agree on the final ratings. This peer pressure element is the mutual part of the process, as no country wants to be publicly shamed for failing to meet international standards. The resulting report is then published, becoming a critical document for global financial institutions to use in their own country risk assessments. The consequences of a poor mutual evaluation are significant and can impact a country's economic standing. If the MER reveals systemic failures in effectiveness or technical compliance, the jurisdiction may be placed under increased monitoring, often called the gray list. In extreme cases of non-cooperation or severe deficiencies, a country might find itself on the black list, which triggers a call for member nations to apply countermeasures. For a compliance professional, these reports are an invaluable source of intelligence. Analyzing an MER for a country where your institution does business allows you to anticipate regulatory shifts and adjust your risk appetite accordingly. It provides a level of transparency into the operational reality of a foreign jurisdiction that you simply cannot get from reading their local statutes alone. In summary, the mutual evaluation process is the engine that drives global adherence to FATF standards through peer review and public accountability. It moves beyond the theoretical by testing how well a country's AML infrastructure performs when faced with real-world criminal threats. By weighing technical compliance against practical effectiveness, the process ensures that the 40 recommendations are more than just a list of ideas. As you prepare for the exam, remember that the ratings awarded during these evaluations influence how we categorize geographical risk in our daily compliance duties. This systematic approach to assessment creates a feedback loop that encourages countries to constantly improve their defenses against the evolving methods used by money launderers. I look forward to seeing you in the next session. Welcome back. In this session, we will examine the Basel Committee on Banking Supervision and its specific contributions to international anti-money laundering standards. The Basel Committee is primarily known for setting capital adequacy standards, but its influence on the prevention of money laundering and terrorist financing is equally significant. Unlike the FATF, which focuses on national policy and legal frameworks, the Basel Committee approaches financial crime through the lens of prudential supervision and bank safety. Its core philosophy is that poor anti-money laundering controls represent a significant risk to a bank's reputation, operational stability, and solvency. When a bank fails to identify its customers or monitor their transactions, it exposes itself to legal sanctions and a loss of public trust. Therefore, the committee's guidelines are designed to integrate money laundering risk management into the broader corporate governance structure of a financial institution. You should view these standards not as a separate set of rules, but as an essential component of professional risk management. A central pillar of the Basel Committee's guidance is the concept of customer due diligence, often referred to as CDD. The committee asserts that banks must have a documented policy for identifying and verifying the identity of their customers, including the ultimate beneficial owners behind corporate structures. This is not merely about collecting documents. It is about establishing a clear understanding of the customer's typical financial behavior. By understanding what constitutes normal activity for a specific client, a bank can more effectively identify deviations that may indicate illicit activity. The committee emphasizes that CDD must be applied to all customers, though the intensity of the due diligence should be calibrated based on the perceived risk level of the specific client or transaction. This creates a logical framework where high-risk entities receive the most scrutiny from the bank's compliance team and senior management. The committee also introduces the vital concept of consolidated KYC, which applies to banking groups operating across multiple jurisdictions. For a global financial institution, it is insufficient to manage risk only at the local branch or subsidiary level. The Basel standards require that a banking group's head office has access to customer and transaction information from all its global operations to ensure an enterprise-wide view of risk. This prevents criminals from exploiting information silos where the parent company is unaware of suspicious patterns occurring in a foreign branch. Managing consolidated KYC is often challenging due to varying national data privacy laws. Yet the committee maintains that the parent bank must ensure that its global standards are applied consistently. If a local jurisdiction prohibits the sharing of information necessary for risk management, the bank may need to reconsider its presence in that market. Another critical aspect of the Basel framework is the clear allocation of responsibility within the bank's hierarchy. The committee makes it clear that the board of directors and senior management are ultimately responsible for the bank's AML and CFT policies. They are expected to foster a strong compliance culture and ensure that the compliance department has adequate resources, authority, and independence. This structure ensures that AML efforts are not relegated to a technical back-office function, but are instead recognized as a primary business risk. Effective risk management under Basel requires 3 lines of defense: the business units that face the customer, the compliance and risk management functions, and finally, the internal audit department. This layered approach ensures that failures in one area of the bank are likely to be detected and corrected by another independent function. The Basel Committee also provides guidance on the ongoing management of existing accounts, rather than just the initial onboarding process. A bank must continuously monitor its customer relationships to ensure that the information on file remains accurate and that transaction patterns remain consistent with the customer's known business profile. This involves periodic reviews of high-risk accounts and the use of automated systems to flag unusual spikes in transaction frequency or volume. When a bank identifies suspicious activity, it must have clear procedures for reporting this information to the National Financial Intelligence Unit. The Basel standards emphasize that a bank should not tip off the customer that a report has been filed, as this could impede a law enforcement investigation. The objective is to create a seamless flow of information between the financial institution and the judicial authorities. Furthermore, the committee's guidelines touch upon the necessity of international cooperation and information sharing between supervisors. Since money laundering is frequently a cross-border crime, bank supervisors in different countries must be able to communicate effectively regarding the health and compliance of multinational banks. The Basel standards encourage supervisors to include AML and CFT risks in their regular examinations of banks. This regulatory oversight acts as an external check on the bank's internal controls, ensuring that the institution's risk management practices meet the minimum global expectations. By following these standards, banks can protect themselves from the severe legal and financial consequences that accompany involvement in money laundering. It is a systematic approach to ensuring that the global banking system remains a hostile environment for the proceeds of crime. I hope this provides a clear picture of how the Basel Committee's standards complement other international efforts by focusing on the operational safety of banks. I will see you in the next lecture. Hello again. It is good to have you back as we move forward through the international standards that shape our compliance frameworks. The Wolfsberg Group represents a unique entity in the regulatory landscape because it is not a government body or a local regulator, but rather an association of 13 global banks. This group essentially performs a form of self-regulation by establishing industry standards that often predated or influenced formal legislation in many jurisdictions. When you encounter the Wolfsberg Group on the CAMS exam, you should think of it as a source of best practices for high-risk banking sectors. Their primary contribution began with the private banking principles, which are developed to address the specific vulnerabilities inherent in managing the wealth of high-net-worth individuals. These principles emphasize that banks must maintain a strict level of oversight when dealing with clients who possess significant assets, as these relationships often involve complexity and a high potential for reputational damage. One of the most critical aspects of the Wolfsberg principles for private banking is the focus on identifying the source of wealth and the source of funds. While these terms are sometimes used interchangeably, they represent distinct concepts that are vital for your understanding of the curriculum. Source of wealth refers to the activities that generated the customer's total net worth, such as an inheritance, a business sale, or professional earnings over several decades. Source of funds, on the other hand, refers to the specific origin of the monies being used for a particular transaction or to fund a specific account. The Wolfsberg Group asserts that for private banking clients, a bank must verify both to ensure the assets are not the proceeds of criminal activity. This requirement is a cornerstone of the group's philosophy on managing the risks associated with affluent and potentially influential clientele. The group also profoundly influenced how the industry approaches correspondent banking through the publication of the Wolfsberg AML Principles for Correspondent Banking. These principles require that a respondent bank, the one receiving the services, be subjected to rigorous due diligence by the provider bank. You should understand that the group advocates for a risk-based approach that evaluates the respondent's home country, its ownership structure, and the nature of its client base. Particularly, these principles forbid the establishment of relationships with shell banks, which are institutions with no physical presence in any country. By setting these standards, the Wolfsberg Group shifted the responsibility onto the larger clearing banks to act as gatekeepers for the global financial system. This ensures that the global payment rails are not easily accessed by institutions with weak or non-existent anti-money laundering controls. Trade finance is another area where the Wolfsberg Group has exerted significant influence, collaborating with the ICC and the Bankers Association for Finance and Trade. The principles regarding trade-based money laundering focus on the fact that banks often deal with documents rather than the physical goods themselves. Because of this limitation, the group emphasizes the importance of screening all parties involved in a trade transaction, including buyers, sellers, and shipping agents. They also highlight the need to look for red flags, such as significantly overvalued or undervalued invoices, which are classic signs of value transfer through trade. In this context, the Wolfsberg Group's guidance helps institutions bridge the gap between financial monitoring and the complexities of international logistics. Their work ensures that the move toward automation in trade finance does not overlook the need for qualitative risk assessment. Beyond these specific sectors, the Wolfsberg Group has published broader guidance on the risk-based approach and the implementation of effective anti-money laundering programs. They argue that a one-size-fits-all model is inefficient and that resources should be directed where the most significant risks reside. This philosophy aligns closely with the FATF recommendations, but provides more granular, practical advice from the perspective of an actual operating financial institution. For the exam, you should remember that the group's publications are not law, yet they are nearly universally adopted as the standard of care. If a bank fails to meet Wolfsberg standards, it is often viewed as having an inadequate compliance program by regulators and peer institutions alike. Understanding these principles is not just about memorizing a list, but about understanding the logic of institutional risk management. I hope this historical and practical context helps as you study these standards. I will see you in the next lecture. Welcome back. The European Union has played a pivotal role in shaping the global anti-money laundering landscape through a series of directives that member states are required to transpose into their own national laws. Unlike regulations, which are immediately binding, these directives set out specific objectives while allowing each country the flexibility to decide how to achieve them within their existing legal frameworks. The history of these directives reflects an evolving understanding of financial crime, starting from a narrow focus on drug trafficking and expanding into a comprehensive regime covering terrorist financing and tax crimes. As the European market became more integrated, the need for a harmonized approach became evident to prevent criminals from exploiting discrepancies between different jurisdictions. Understanding the trajectory of these directives is essential for the CAMS exam because it demonstrates how international standards like the FATF recommendations are practically implemented at a regional level. The first anti-money laundering directive, adopted in 1991, was relatively limited in scope compared to what we see today. It primarily targeted the laundering of proceeds from drug-related offenses and was applicable mainly to credit and financial institutions. At this stage, the focus was on establishing the initial requirements for customer identification and the reporting of suspicious transactions to national authorities. While it seems rudimentary by contemporary standards, it established the fundamental principle that financial institutions have a gatekeeper responsibility in the global financial system. This directive laid the groundwork for the shift from bank secrecy toward transparency, a trend that has only accelerated in subsequent decades. It was a reaction to the growing realization that the removal of internal borders within the EU required a collective defense against organized crime. With the second directive in 2001, the EU significantly broadened the definition of money laundering to include proceeds from all serious crimes, not just drug trafficking. One of the most significant shifts during this period was the extension of AML obligations to non-financial professions, such as auditors, external accountants, tax advisors, and legal professionals. This expansion recognized that criminals often use intermediaries to facilitate complex schemes and obscure the origin of illicit funds. For example, a lawyer setting up a shell company for a client could unknowingly or knowingly provide a layer of legitimacy to criminal proceeds. By bringing these designated non-financial businesses and professions into the regulatory fold, the EU sought to close gaps that existed outside the traditional banking sector. This directive also updated the EU framework to reflect the revised FATF standards issued during that era. The third directive, introduced in 2005, marked a major milestone by explicitly incorporating measures to combat terrorist financing alongside money laundering. It introduced the concept of a risk-based approach, allowing institutions to apply simplified or enhanced due diligence based on the perceived risk of a customer or transaction. This was a move away from a one-size-fits-all compliance model, acknowledging that a local small business poses a different risk profile than a foreign politically exposed person. Furthermore, it required the identification of ultimate beneficial owners, defined as individuals who steer or own more than 25% of an entity. This was a critical step in peeling back the layers of corporate anonymity that frequently hide the true actors behind a transaction. The third directive also mandated that each member state establish a financial intelligence unit to receive and analyze suspicious activity reports. The fourth directive, which member states were required to implement by 2017, represented a shift toward even greater transparency and a more rigorous risk-based philosophy. Perhaps its most notable requirement was the establishment of central registers of beneficial ownership information for corporate and other legal entities. This meant that information about who truly owns and controls a company would no longer be hidden behind complex legal structures, but would be accessible to competent authorities and obligated entities. It also lowered the threshold for occasional transactions in cash to 10,000 euros, capturing more high-value activity that could be used for illicit purposes. Additionally, the fourth directive expanded the definition of politically exposed persons to include domestic figures, recognizing that corruption is not a risk exclusive to foreign officials. This change required institutions to scrutinize a much larger pool of high-risk individuals and their associates. The fifth directive, adopted in 2018 and implemented shortly thereafter, addressed emerging risks related to virtual currencies and anonymous prepaid cards. It brought virtual currency exchange platforms and custodian wallet providers under the scope of AML regulations, requiring them to perform customer due diligence and report suspicious activity. This was a direct response to the increasing use of crypto assets in criminal financing and the need for oversight in the burgeoning fintech sector. The directive also enhanced the powers of financial intelligence units, giving them swifter access to information through centralized bank account registers. Transparency was further increased by ensuring public access to beneficial ownership certificates for companies, a move aimed at deterring the use of shell companies by increasing the likelihood of exposure. This directive emphasized that transparency is the primary enemy of the money launderer. The sixth directive, focusing on the criminal law aspects of money laundering, sought to harmonize the definition of offenses and the severity of sanctions across the EU. It introduced a comprehensive list of 22 predicate offenses that constitute money laundering, ensuring that there is no ambiguity about what activities lead to a laundering charge. Importantly, it extended criminal liability to legal persons, meaning that corporations can be held liable for crimes committed for their benefit by individuals in leading positions. This adds a layer of corporate accountability, encouraging firms to maintain robust internal controls to avoid heavy fines or judicial winding-up orders. By standardizing these definitions and penalties, the EU aimed to prevent forum shopping, where criminals might seek to operate in member states with more lenient legal penalties. This directive ensures that the legal consequences for money laundering are consistently high across the entire economic area. I hope this overview helps you understand the evolution of the EU's legal framework. See you in the next lecture. Hello again. It is good to see you back as we continue our preparation for the CAMS exam. Let us solidify our knowledge of global regulatory frameworks with a short quiz regarding international standards. Which of the following is a primary objective of the Wolfsberg Group's principles as they relate to private banking? A. Defining the specific criminal penalties for money laundering in member jurisdictions. B. Establishing a framework for the exchange of information between law enforcement agencies. C. providing a set of ethical and practical guidelines for identifying and managing high-risk customer relationships. D. Mandating the implementation of the European Union's fourth anti-money laundering directive. Please pause the video now and take a moment to consider which of these options best aligns with the purpose of this specific international body. The correct answer is C, providing a set of ethical and practical guidelines for identifying and managing high-risk customer relationships. To understand why this is the correct answer, we must distinguish between the various international bodies we have discussed. The Wolfsberg Group is an association of global banks, not a government body or a legislative entity. Therefore, it does not have the authority to define criminal penalties, as suggested in Option A, nor can it mandate the implementation of regional legislation like the EU directives mentioned in Option D. While information exchange is important, Option B is more characteristic of the Egmont Group of financial intelligence units rather than a set of banking principles. The Wolfsberg principles are fundamentally about the industry regulating itself through best practices, particularly focusing on client due diligence and the ethical handling of private banking clients to prevent financial crime. Moving back to the broader scope of our recent lessons, remember that the FATF 40 recommendations serve as the universal blueprint for national legislation. While the FATF sets the standards, the mutual evaluation process ensures those standards are actually being applied through peer reviews. We also looked at the Basel Committee, which focuses specifically on the institutional safety and soundness of banks. Success on the exam requires you to distinguish between these bodies based on their membership and their primary focus area, whether it is high-level policy, technical banking supervision, or industry-led guidance. I hope this quick check helped clarify the distinctions between these important international organizations. I will see you in the next lecture. Welcome back. When we discuss the architecture of an anti-money laundering program, we're essentially looking at a governance framework designed to survive scrutiny. An effective program is not a collection of ad hoc policies, but a structured system built upon 4 foundational pillars that provide the necessary stability for financial institutions. These pillars include a system of internal policies and controls, the designation of a specific compliance officer, an ongoing employee training program, and an independent audit function to test the system's integrity. If any one of these components is weak or missing, the entire compliance structure becomes vulnerable to regulatory failure or criminal exploitation. We must view these elements as a cohesive unit where each part reinforces the others to create a comprehensive defense against illicit financial flows. Internal controls represent the first pillar and serve as the operational manual for the entire organization's compliance efforts. These are the written policies, procedures, and processes designed to mitigate the specific risks identified by the institution during its risk assessment phase. You cannot simply download a template and expect it to work. The controls must be tailored to the nature, complexity, and volume of the business being conducted. These controls dictate how customers are onboarded, how transactions are monitored, and how suspicious patterns are escalated for further review. They provide the clear, objective standards that employees must follow to ensure that the institution remains in compliance with both local and international regulations. Without robust internal controls, the program lacks the necessary consistency to be defensible during a regulatory examination. The second pillar is the designation of a qualified individual to oversee the daily operations of the AML program, commonly referred to as the AML compliance officer. This individual must possess a sufficient level of seniority and authority within the organization to effect change and command the respect of various business lines. It is not enough to simply assign the title to an employee. The officer must have the resources and independence required to perform their duties without undue influence from profit-driven departments. They serve as the primary point of contact for regulatory bodies and are responsible for ensuring that the internal controls are effectively implemented and updated as laws change. Their role is central to the governance structure, providing a single point of accountability for the organization's compliance posture. Education and training form the third pillar, ensuring that all relevant staff members understand their specific roles within the compliance framework. Usefulness of high-level policies is limited if the frontline staff and middle management do not understand how to apply them in real-world scenarios. Training should not be a generic, one-size-fits-all presentation, but should be specialized based on the specific functions of the employees receiving it. For example, a teller requires different knowledge than a commercial loan officer or a member of the board of directors. The goal is to cultivate an institutional culture of compliance, where every employee is capable of identifying red flags and understands the reporting chain. Consistent, documented training sessions prove to regulators that the institution is committed to maintaining a knowledgeable workforce. The final pillar is the independent testing or audit function, which serves as a quality assurance mechanism for the entire AML program. This testing must be conducted by parties who are not involved in the day-to-day operations of the compliance department, such as internal auditors or external third-party consultants. The objective is to provide an unbiased assessment of the program's effectiveness and to identify any gaps or weaknesses that may have developed over time. The auditors review the internal controls, test transaction monitoring systems, and evaluate the adequacy of the training program and the compliance officer's performance. They produce a report that is typically shared with senior management and the board of directors to facilitate necessary improvements. This independent oversight ensures that the program remains robust and evolves alongside changing risk landscapes and regulatory expectations. I'll see you in the next lecture. Hello, it is good to have you back. The risk-based approach is a fundamental shift from a rigid, check-the-box compliance framework to one that prioritizes resources where they are most needed. In a purely rule-based system, a financial institution might apply the same level of scrutiny to a local small business as it does to a complex offshore entity, which is fundamentally inefficient. The risk-based approach requires us to understand the specific threats facing the organization and to adjust our controls accordingly. By doing this, we can ensure that high-risk activities receive the highest level of scrutiny while low-risk activities are handled with more streamlined processes. This methodology is not merely a suggestion, but a requirement emphasized by the Financial Action Task Force to ensure that compliance efforts are both effective and proportionate. When we apply this approach to customer risk profiles, we must look at a variety of indicators that suggest a higher likelihood of money laundering or terrorist financing. This involves evaluating the customer's occupation, the source of their wealth, and the nature of their business activities. For instance, a customer who deals in high-value commodities like precious stones or works in a cash-intensive industry presents a different risk profile than a salaried employee from a local firm. We categorize these customers into tiers, such as high, medium, or low risk, which then dictates the frequency of our monitoring and the depth of our due diligence. The goal is to create a dynamic system where the level of oversight remains commensurate with the perceived risk of the individual or entity. Geographic risk is another critical dimension that informs how we allocate our compliance efforts. Some jurisdictions are known to have deficient anti-money laundering frameworks, high levels of corruption, or are subject to international sanctions. We must identify these high-risk locations and apply enhanced measures to any transactions or business relationships originating from or flowing through them. This does not necessarily mean we must avoid all business in these regions, but it does mean we must be more vigilant in our verification processes. By systematically mapping out which countries or territories pose the greatest threat, the institution can better protect itself from being used as a conduit for illicit funds. The risk inherent in products and services must also be carefully weighed within the broader compliance framework. Certain financial instruments, such as private banking services, wire transfers, or anonymous stored value cards are more susceptible to being exploited for money laundering. We analyze how these products function, their potential for anonymity, and the speed at which they allow money to move through the financial system. If a product offers features that could easily hide the trail of transactions, it requires more robust defensive mechanisms and more frequent reporting. This allows the institution to focus its sophisticated monitoring tools on the services that present the path of least resistance to criminal actors. Ultimately, the primary benefit of the risk-based approach is the efficient allocation of finite compliance resources. No institution has an unlimited budget or an infinite number of analysts to review every single transaction. By focusing our attention on the highest risks identified through our profiling of customers, geographies, and products, we maximize the impact of our anti-money laundering program. This targeted focus leads to a higher probability of detecting truly suspicious activity while minimizing the burden on legitimate customers. It moves compliance from a static administrative task to a strategic function that actively manages the institution's exposure to financial crime. Thank you for your time, and I look forward to seeing you in the next lesson. Hello. It is good to have you back for this discussion on the architectural pillars of an effective anti-money laundering program. The designation of a compliance officer is not merely a regulatory checkbox. It is the creation of a central authority figure who governs the integrity of the institution's financial dealings. This individual serves as the focal point for all AML and counterterrorist financing activities, acting as the primary liaison between the organization and external regulatory bodies or law enforcement agencies. We must view the compliance officer as a bridge between the theoretical requirements of international standards and the practical execution of daily banking operations. Their mandate includes the development and constant refinement of the internal compliance manual, ensuring that every policy remains aligned with the shifting landscape of global financial crime. Without a clearly identified individual holding this responsibility, accountability becomes diffused across the organization, leading to systemic failures in risk management. This role requires a deep understanding of the institution's specific risk profile, its product offerings, and its customer base to tailor the compliance framework effectively. Independence is the most critical attribute of a successful compliance officer, as the role's effectiveness is entirely dependent on its ability to operate without undue influence from business lines. If the person responsible for identifying suspicious activity reports to a manager whose primary goal is revenue generation, an inherent conflict of interest arises that compromises the entire AML program. To mitigate this risk, the compliance officer must have a direct reporting line to the board of directors or a similar senior governance body, bypassing middle management and sales-oriented executives. This structural independence ensures that compliance concerns are escalated to the highest level of authority without being filtered or suppressed by those focused on short-term profitability. Furthermore, the individual must have sufficient seniority within the corporate hierarchy to command respect and influence decision-making at the executive level. An underpowered compliance officer lacks the political capital needed to enforce strict standards when they conflict with high-value business opportunities. Beyond structural independence, the institution must provide the compliance officer with adequate resources, including both human capital and technological tools, to perform their duties. It is insufficient to appoint a qualified person if they are then starved of the budget necessary to implement robust monitoring systems or hire a competent support staff. The compliance officer is responsible for overseeing the automated transaction monitoring systems and ensuring that the parameters and thresholds are accurately calibrated to catch suspicious patterns. They are also tasked with ensuring that all relevant employees receive periodic training that is relevant to their specific roles and risks. This oversight extends to the review of internal investigations and the final decision-making process regarding the filing of suspicious activity reports, SARs, or suspicious transaction reports, STRs. The role demands a proactive stance, where the officer is not just reacting to alerts, but actively seeking vulnerabilities within the institutional framework. Internal communication is as vital as the external reporting function, as the compliance officer must disseminate information about new legislative changes or emerging money laundering typologies to all departments. They act as a consultant to the front office staff, providing guidance on how to handle high-risk clients or complex corporate structures that may obscure beneficial ownership. When a new product or service is launched, the compliance officer must be involved in the design phase to conduct a thorough risk assessment before the offering goes live. This preventative approach is far more efficient than attempting to patch security holes after a product has already been exposed to the market. The officer also monitors the effectiveness of the AML program by reviewing data trends, such as the volume of alerts generated versus the number of reports actually filed. Such metrics provide an empirical basis for reporting to the board about the overall health and compliance status of the institution. The professional qualifications of the compliance officer should reflect the complexity of the institution's operations and the jurisdictional requirements in which it operates. While specific educational backgrounds may vary, the individual must possess an intricate knowledge of the local and international AML laws that apply to their specific business sector. They are the person who will be questioned during regulatory examinations and must be able to demonstrate that the institution's risk-based approach is founded on sound logic and documented evidence. In many jurisdictions, the compliance officer may even face personal liability for systemic failures within the program, which underscores the necessity of their autonomy and authority. Their presence ensures that the organization maintains a culture of compliance where legal and ethical boundaries are respected even when they seem to impede business growth. Ultimately, the compliance officer is the guardian of the institution's reputation and its continued license to operate within the global financial system. I look forward to continuing our examination of compliance program elements in the next lecture. Welcome back. In this lesson, we are going to examine how to structure an anti-money laundering training program that actually fulfills its functional purpose within a financial institution. A common mistake in compliance is treating employee training as a generic, one-size-fits-all annual checkbox exercise that applies the same content to everyone from the mailroom to the boardroom. For a training program to be effective, it must be targeted and relevant to the specific roles and responsibilities of the individuals receiving it. This means that the content delivered to a frontline teller should look fundamentally different from the material presented to a commercial loan officer or a member of the internal audit team. Frontline staff need to recognize the red flags associated with cash transactions and behavioral cues, whereas relationship managers for high net worth clients must understand the nuances of shell companies and complex trust structures. If the training is not tailored to the specific operational risks of a department, the staff will likely fail to identify the suspicious activities most likely to occur within their particular business line. Senior management and the board of directors require a different pedagogical approach entirely, focusing on oversight responsibilities rather than operational procedures. These individuals do not necessarily need to know how to fill out a suspicious activity report, but they must understand the legal and regulatory consequences of noncompliance. Their training should emphasize the institution's risk appetite, the results of the enterprise-wide risk assessment, and the potential impact of enforcement actions on the organization's reputation and bottom line. By ensuring that leadership understands the gravity of money laundering risks, the compliance officer secures the necessary tone at the top to foster a culture of compliance throughout the firm. Without this high-level understanding, the AML program is likely to be under-resourced and viewed as a secondary concern to profit generation. The timing and frequency of training are just as critical as the content itself, as a single annual session is rarely sufficient to keep pace with evolving criminal methodologies. Effective programs utilize an ongoing approach that includes initial orientation for new hires, as well as localized updates when new products are launched or regulations change. It is far more effective to provide incremental, topical training when a shift in the landscape occurs than to wait for an annual cycle to address a new vulnerability. For example, if the institution begins offering decentralized finance products or crypto asset services, the relevant departments should receive immediate, specialized training on those specific risks. Continuous reinforcement ensures that compliance remains a daily consideration rather than a distant memory of a session held months prior. Training must also be measurable and documented to withstand the scrutiny of auditors and regulatory examiners. Simply providing the information is not enough. The institution must demonstrate that the employees have actually comprehended the material through testing or practical evaluations. Documentation should include the names of attendees, the dates of the sessions, and a detailed syllabus of the topics covered to provide a clear audit trail. This record keeping serves as defensive evidence during an investigation, proving that the institution took reasonable steps to educate its workforce. Furthermore, if certain employees consistently perform poorly on assessments, the program should have a mechanism for remedial training to address these specific knowledge gaps. Finally, the delivery method of the training should reflect the technical needs and geographical distribution of the workforce. While computer-based training is efficient for large-scale deployments of foundational knowledge, more complex topics often benefit from face-to-face workshops and case study discussions. These interactive formats allow employees to ask questions and grapple with the gray areas of compliance that automated modules might oversimplify. The goal is to move beyond rote memorization of rules toward a functional understanding of how to apply professional skepticism in real-world scenarios. When training is treated as a strategic asset rather than a regulatory burden, it becomes one of the most powerful tools in a firm's defensive arsenal. That concludes our discussion on training. I will see you in the next lecture. Welcome back. When we design a robust anti-money laundering program, we often focus on the internal mechanics of risk assessment and the daily duties of the compliance officer. However, a system is only as reliable as its verification mechanism, which is where the independent audit function becomes a critical pillar. The primary objective of an independent audit is to evaluate the adequacy, effectiveness, and regulatory compliance of the firm's AML program from an objective standpoint. It is not merely a box-ticking exercise, but a formal evaluation to ensure that the controls we claim are in place are actually functioning as intended. Without this layer of scrutiny, a firm remains blind to systemic failures until they are uncovered by a regulator, which is often too late. This function provides the board of directors and senior management with the necessary assurance that the organization's risk appetite is being respected. The term independent is the most vital characteristic of this function, and it implies that the individuals conducting the audit must not be involved in the creation or execution of the AML processes they are reviewing. In many large organizations, this is handled by an internal audit department that reports directly to the board or an audit committee rather than to the compliance officer. In smaller firms, this independence might be achieved by hiring an external consultancy or a qualified third party to perform the review. The goal is to eliminate any conflict of interest that might lead someone to overlook a deficiency in a process they helped design. If the person who wrote the Know Your Customer procedures is also the one auditing them, the audit loses its integrity and its value as a defensive measure. We must ensure that the reviewer has the authority to speak truth to power without fear of professional repercussions. A comprehensive audit must test the effectiveness of the compliance program by sampling actual files and transactions rather than just reviewing policy documents. It is one thing to have a beautifully written manual that says all high-risk customers undergo enhanced due diligence, but it is another thing entirely to find evidence of that work in the files. The auditor should look at the methodology used for the enterprise-wide risk assessment and verify that the results of that assessment actually inform the program's resource allocation. They will examine whether the automated monitoring systems are calibrated correctly and whether the alerts generated are being handled in a timely and logical manner. If the auditor finds that alerts are being closed without sufficient justification, this points to a failure in the program's operational effectiveness. The audit scope should be broad enough to capture every element of the AML framework, from employee training records to the filing of suspicious activity reports. Regulatory compliance is another major focus, as the audit must verify that the firm is meeting its legal obligations under the specific jurisdictions in which it operates. This involves checking that the firm captures required data points for beneficial ownership and that it adheres to the strict timelines dictated by law for reporting suspicious transactions. The auditor will often interview key staff members to gauge their understanding of their roles and the firm's specific vulnerabilities. If employees at the front line are unaware of how to escalate a suspicious incident, the training program has failed regardless of how many people sign the attendance sheet. The findings of the audit must be documented in a written report that clearly outlines any deficiencies or areas requiring remediation. Management is then expected to provide a formal response and a timeline for correcting these issues, which the auditor will verify in a follow-up review. The frequency of these audits should be determined by the firm's risk profile, though most regulators expect an annual review or a review every 18 to 24 months at a minimum. If a firm undergoes significant changes, such as a merger, the introduction of a new product line, or the acquisition of a digital asset platform, an ad hoc audit might be necessary to ensure the controls remain relevant. Risk is dynamic, and a static audit schedule that ignores significant organizational shifts is a risk in itself. By maintaining a rigorous and independent audit cycle, the firm creates a feedback loop that allows for continuous improvement of the AML infrastructure. It acts as a safety net that catches errors before they evolve into systemic violations. Ultimately, the independent audit is the mechanism that proves the program works when no one is watching. I look forward to seeing you in the next session. Welcome back. Today we shift our focus to the structural foundation of a risk-based approach, specifically how an institution evaluates its inherent vulnerabilities through an enterprise-wide risk assessment. An enterprise-wide risk assessment is a systematic process meant to identify, assess, and understand the money laundering and terrorist financing risks to which a financial institution is exposed. Instead of looking at individual accounts in isolation, this methodology looks at the entire organization to determine its overall risk appetite and the adequacy of its internal controls. We generally divide this into two main components: the assessment of inherent risk and the evaluation of the effectiveness of the control environment. Inherent risk represents the exposure to risk in the absence of any internal controls, which helps us understand the baseline of what we are dealing with. By quantifying these risks across different business lines, an institution can allocate its compliance resources where they are most needed. This process is not a one-time activity, but a continuous cycle that must be refreshed as the institution's products, services, and geographic footprint evolve. To build a robust methodology, we must leverage both qualitative and quantitative data to reach a conclusion about the residual risk. Quantitative data involves hard numbers, such as the total volume of wire transfers, the number of high-risk customers, or the percentage of transactions involving jurisdictions known for secrecy. For example, if a bank sees a 20% increase in transactions originating from a FATF gray-listed country, the quantitative data signals a rising risk profile. On the other hand, qualitative data involves subjective professional judgment, such as the quality of the compliance culture or the complexity of the regulatory environment. A strong methodology uses both to ensure that the final risk score is not just a mathematical output, but a nuanced reflection of reality. Without a balanced approach, An institution might miss emerging threats that haven't yet manifested in the transaction data. When we begin identifying institutional vulnerabilities, we typically categorize risks into several distinct pillars: customers, products, services, delivery channels, and geographies. Each of these categories requires a specific set of indicators to measure potential exploitation by illicit actors. For instance, delivery channels that allow for non-face-to-face onboarding inherently present a higher risk than those requiring physical presence. Similarly, products that provide high liquidity, like wire transfers or stored value cards, are more vulnerable than long-term insurance products with restricted withdrawal conditions. We must also evaluate the geographic risk, looking not only at where the institution operates, but where its customers and their beneficiaries are located. By breaking the institution down into these segments, we can pinpoint specific areas where the risk of financial crime is concentrated. Once inherent risks are mapped, we must evaluate the control environment to determine the residual risk, which is the risk remaining after controls are applied. The controls we examine include customer due diligence procedures, transaction monitoring systems, and the robustness of the independent audit function. If an institution has a high inherent risk in its correspondent banking business, but maintains a manual, paper-based monitoring system, the control effectiveness will be considered low. This gap between high inherent risk and weak controls leads to a high residual risk, which usually triggers a requirement for enhanced mitigation strategies. It is also important to consider the human element, such as the expertise level of the compliance staff and their ability to interpret red flags. A control that exists on paper but is not effectively implemented by staff provides a false sense of security. The outcome of the enterprise-wide risk assessment should directly inform the institution's AML program and its training priorities. If the assessment reveals a high vulnerability in a specific business unit, such as trade finance, the institution should focus its next round of specialized training on trade-based money laundering techniques. Furthermore, the findings are essential for senior management and the board of directors to make informed decisions about business expansion or the discontinuation of certain high-risk services. Regulators expect this document to be the living evidence of an institution's commitment to a risk-based approach. If the assessment is stale or fails to cover all business lines, the entire compliance program can be deemed deficient during a regulatory examination. Ultimately, the goal is to create a feedback loop where the risk assessment informs the controls and the controls generate data that improves the next assessment. Until next time, welcome back. We have covered the fundamental structure of an internal AML framework, and it is now time to ensure that these concepts are firmly rooted in your understanding before we move into the specifics of customer due diligence. Let's solidify our knowledge with a short quiz. An institution is reviewing its AML program to ensure it meets the standard for pillars and follows a risk-based approach. The board of directors wants to know which specific element is required to satisfy the third pillar and who should ultimately be responsible for the program's daily operation. Which of the following best describes these requirements? A. An annual external audit and the chief executive officer. B. Ongoing employee training and the designated AML compliance officer. C. A system of internal controls and the board of directors. D. Implementation of automated monitoring software and the internal audit manager. Please pause the video now to consider your answer before we proceed to the explanation. The correct answer is B. Ongoing employee training and the designated AML compliance officer. To understand why this is the correct choice, we must look at the traditional 4 pillars of an AML compliance program. These consist of a system of internal policies and controls, the designation of a specific compliance officer, an ongoing employee training program, and an independent audit function to test the system. The question specifically asks for the third pillar, which is the training component. While internal controls and audits are equally necessary, they represent different pillars within the same framework. Training is the mechanism that ensures the human element of the institution is capable of identifying and escalating suspicious activity, which is why it is codified as a core requirement. The second part of the question addresses the role of the AML officer. While the board of directors has the ultimate oversight responsibility and must approve the program, they do not manage the day-to-day operations. The AML officer is the individual who must have the authority and resources to manage the program independently. This person serves as the point of contact for regulatory bodies and ensures that the institution's internal controls are being followed. Assigning this responsibility to the CEO or an audit manager would create conflicts of interest or dilute the specialized focus required for AML oversight. Finally, we should address the risk-based approach mentioned in the prompt. A risk-based approach dictates that an institution should allocate its resources according to the level of risk posed by its customers, products, and geographic locations. This means that the pillars, such as training and internal controls, must be tailored to the specific risk profile of the bank rather than being applied as a generic checklist. For instance, employees in high-risk departments might receive more frequent or specialized training than those in low-risk administrative roles. This alignment between the pillars and the risk assessment is what constitutes an effective, modern AML program. I'll see you in the next lecture. Hello, welcome back to the course as we begin our focused look at the practicalities of customer due diligence. Know Your Customer, or KYC, is often described as the cornerstone of any effective anti-money laundering program because it moves the institution away from anonymous transactions to a risk-based understanding of the client base. At its most fundamental level, KYC is a set of policies and procedures that ensure a financial institution knows exactly who they're doing business with and what kind of activity is normal for that specific entity. This process is not a one-time event during account opening, but rather a continuous effort to maintain an accurate profile of the customer throughout the relationship. We must distinguish between the mere collection of data and the meaningful verification of that data against independent, reliable sources. Without a robust KYC framework, all subsequent monitoring and reporting efforts are built on a flawed foundation, making it nearly impossible to detect deviations that signify criminal intent. The first pillar of this process is reliable customer identification, which involves gathering a specific set of data points as mandated by local regulations and internal risk appetite. For an individual, this typically includes their full legal name, a unique government-issued identification number, their date of birth, and their physical residential address. It is important to remember that collecting this information is only half of the requirement. The institution must also verify it. Identification is the act of the customer claiming an identity, while verification is the process of the institution confirming that claim using documents, data, or information obtained from a reliable and independent source. In modern digital banking environments, this might involve checking electronic databases or using biometric technology, but the principle remains the same. The institution must be satisfied that the customer is who they say they are. When we shift our focus from individuals to legal entities, such as corporations or trusts, the identification process becomes significantly more complex but no less critical. For these customers, the institution must obtain documentation that proves the entity exists, such as articles of incorporation, a partnership agreement, or a business license. You must also understand the nature of the entity's business and its ownership structure to ensure that the entity is not a shell company designed purely to obscure the flow of illicit funds. Obtaining demographic information for a legal entity includes identifying its principal place of business, the names of its directors, and the legal powers that regulate its operations. This high-level data provides the context necessary to evaluate whether the business transactions that follow are consistent with the declared purpose of the account. Obtaining demographic information is not just a regulatory hurdle. It is a strategic requirement for assessing the risk profile of each customer. This involves understanding the customer's occupation or business activity, their source of wealth, and the expected volume and type of transactions they intend to conduct. If a customer is a local retail merchant, their demographic profile will suggest frequent cash deposits and domestic transfers, which would be considered normal activity. Conversely, if that same merchant suddenly begins receiving high-value international wire transfers from high-risk jurisdictions, the demographic data you collected at onboarding serves as the baseline to flag this as suspicious. By systematically capturing and verifying this information, you create a transparent environment where the institution can effectively allocate its resources to monitor the highest risk relationships. Good luck with your continued studies, and I will see you in the next lecture. Hello and welcome back. We continue our exploration of the customer life cycle by moving from standard procedures into the more rigorous territory of enhanced due diligence. When we talk about enhanced due diligence, or EDD, we're looking at a subset of your customer base that presents a higher risk profile than the average retail or corporate client. While standard due diligence focuses on verifying identity, EDD requires a deeper dive into the nature of the customer's wealth and the legitimacy of their business activities. This isn't just a matter of adding more documents to a file. It's a qualitative shift in how we evaluate the risk of money laundering or terrorist financing. The goal is to gain enough information to effectively mitigate the specific risks that triggered the higher classification in the first place. You will find that EDD is most often applied to categories such as politically exposed persons, customers from jurisdictions with strategic AML deficiencies, or those involved in high cash turnover industries. A fundamental component of EDD is establishing the source of wealth and the source of funds for the customer. These two concepts are often confused, but they serve different diagnostic purposes in a risk assessment. Source of wealth refers to the origin of the customer's entire net worth, explaining how they accumulated their assets over time through inheritance, business ownership, or investments. On the other hand, source of funds is more transactional, focusing on where the money for a specific deposit or business relationship originated. In an ED context, you must verify this information through independent and reliable sources rather than relying solely on the customer's self-declaration. This level of scrutiny ensures that the financial institution is not inadvertently facilitating the integration of illicit proceeds into the legitimate economy. The application of ED also involves a significant increase in the frequency and intensity of monitoring. While a standard customer might undergo a periodic review every few years, a high-risk customer subject to EDD might be reviewed annually or even more frequently, depending on their activity. This process includes analyzing transaction patterns to ensure they align with the expected behavior established during the onboarding phase. If a high-risk client suddenly starts moving large sums of money through offshore accounts that weren't mentioned in the initial profile, the EDD framework should flag this as a significant discrepancy. You are essentially building a more detailed norm for the customer so that any deviations become more apparent to the compliance team. Another critical aspect of EDD is the requirement for senior management approval before establishing or continuing a relationship with a high-risk customer. This ensures that the institution's leadership is aware of the potential legal and reputational risks and has explicitly accepted them. This top-down oversight is a key pillar of a robust AML program, as it prevents frontline staff from making risk-based decisions that might conflict with the organization's overall risk appetite. Furthermore, EDD often necessitates more investigative measures, such as conducting site visits or using third-party intelligence reports to verify the legitimacy of a business's physical presence and operations. By gathering this level of granular detail, you can make an informed decision about whether the risk remains within manageable limits. Ultimately, enhanced due diligence is a dynamic process rather than a one-time check during the account opening phase. As the customer's business evolves or as geopolitical risks shift, the EDD measures must be adapted to reflect the current reality. If a jurisdiction where the client operates is added to a high-risk list, the institution must reevaluate the risk profile and potentially apply even more stringent controls. This iterative approach allows the compliance function to stay ahead of potential threats and ensures that the institution's defenses are commensurate with the risks it faces. By adhering to these rigorous standards, you provide a necessary layer of protection for the financial system and the institution itself. That concludes our discussion on the mechanics and application of enhanced due diligence. I look forward to seeing you in the next session, where we will examine ultimate beneficial ownership. Hello again. It is good to have you back as we continue our examination of customer due diligence. When we talk about legal entities such as corporations, trusts, or foundations, we often encounter a layer of abstraction that hides the actual human beings behind the curtain. The concept of ultimate beneficial ownership, or UBO, is the regulatory mechanism designed to peel away these layers to reveal the natural persons who truly own or control a legal entity. It is not enough to know that a company is owned by another holding company in a different jurisdiction. The objective of a robust AML program is to identify the physical individuals at the end of that chain. Without this visibility, money launderers can easily exploit the anonymity provided by corporate shells to move illicit funds through the global financial system. We must distinguish between legal ownership, which refers to the names on the official registry, and beneficial ownership, which focuses on who actually reaps the benefits and exercises final control. The Financial Action Task Force and various international directives generally define a beneficial owner as any natural person who ultimately owns or controls a customer. This control can be exercised through direct ownership of a specific percentage of shares, typically set at 25% or more in many jurisdictions. However, relying solely on a percentage threshold is a common mistake that compliance professionals must avoid. Even if no single person owns 25%, there is often an individual who exercises significant control through other means, such as voting rights, power of attorney, or the ability to appoint the board of directors. If no such individual can be identified after exhaustive efforts, the focus shifts to a natural person who holds the position of senior managing official within the entity. The complexity of corporate structures can be a deliberate tactic used to obfuscate the origin of funds, which is why your investigation must be thorough. You might encounter a scenario where Company A is owned by Company B, which in turn is owned by a private trust where the beneficiaries are unclear. In such cases, you are required to map out the entire ownership structure until you reach a natural person, regardless of how many jurisdictions or legal forms the path traverses. This process helps mitigate the risk of dealing with entities that are merely shells designed to facilitate tax evasion, corruption, or terrorism financing. By unmasking the individuals behind these vehicles, you ensure that sanctions screening and PEP checks are being applied to the correct people rather than just a faceless corporate name. Verifying UBO information requires more than just accepting a self-declaration from the client at face value. While a client might provide an organizational chart, a prudent compliance officer should corroborate this information using independent and reliable sources, such as government registries, shareholder agreements, or audited financial statements. In some high-risk jurisdictions, official registries may be unreliable or non-existent, which necessitates an even higher level of scrutiny and perhaps the use of specialized third-party intelligence providers. Any discrepancy between what the client reports and what your independent research reveals should be treated as a significant red flag that potentially warrants an investigation into whether the customer is attempting to conceal its true controllers. Legal arrangements like trusts present a unique challenge because the roles of settlor, trustee, protector, and beneficiary can be split among different parties. For these arrangements, the beneficial owner is not just one person, but rather a collection of people, including the settlor, the trustees, the protector if one exists, and all beneficiaries. Even if the beneficiaries are not yet named, perhaps defined as a class of people, the institution must have enough information to identify who will eventually benefit from the assets. Failure to identify these parties leaves the institution vulnerable to being used as a conduit for tiered laundering schemes where assets are moved into a trust to break the audit trail. Understanding the ultimate beneficial owner is a fundamental pillar of the risk-based approach because the risk profile of an entity is inextricably linked to the reputation and activities of its owners. If a natural person behind a corporate client is a known associate of a criminal organization or is on a sanctions list, the legal structure itself becomes high risk by proxy. You cannot accurately perform a risk assessment or decide on the appropriate level of monitoring without this information. This is why UBO identification is not a one-time administrative task, but a continuous requirement. If the ownership structure changes during the course of the business relationship, the firm must update its records and reevaluate the risk associated with that entity. Ultimately, the goal is transparency across the financial system to prevent the misuse of legal persons for criminal purposes. By rigorously identifying natural persons behind complex corporate shells, we remove the shield of anonymity that many launderers depend on. This ensures that the financial institution remains compliant with international standards and protects itself from the severe legal and reputational consequences of being complicit in financial crime. This process is often difficult and time-consuming, but it remains one of the most effective tools we have in the fight against money laundering and the financing of terrorism. I look forward to discussing how these concepts apply to politically exposed persons in our next session. See you then. Hello, and welcome back. When we discuss customer risk profiles, few categories demand as much attention as politically exposed persons, or PEPs. A PEP is not a criminal by definition, but rather an individual who holds a prominent public position that potentially affords them the opportunity to abuse the financial system for personal gain. This position of influence creates a distinct vulnerability to bribery, corruption, and the subsequent laundering of illicit funds. As an anti-money laundering professional, your task is not to exclude these individuals from the financial system, but to apply a level of scrutiny that balances their right to access banking services with the high inherent risk they represent. Understanding the nuances of these risks is essential for passing the CAMS exam and for maintaining a robust compliance framework. The Financial Action Task Force distinguishes between foreign and domestic PEPs, a distinction that carries significant weight in how we calibrate our due diligence. A foreign PEP is someone entrusted with a prominent public function by a foreign country, such as a head of state, a senior politician, or a high-ranking judicial or military official. Historically, international standards were more stringent regarding foreign PEPs because the geographical and jurisdictional distance makes it harder to verify the legitimacy of their wealth. Domestic PEPs, on the other hand, hold similar roles within the country where the financial institution is based. While the risk of corruption remains identical in principle, the proximity often allows for more transparent access to public records concerning their income and assets. The classification of an individual as a PEP also extends beyond the primary office holder to include their family members and close associates. This is a critical concept because those looking to hide the proceeds of corruption rarely do so in their own names, preferring instead to use the bank accounts of spouses, children, or business partners. We refer to these individuals as PEPs by association or related parties. When you encounter a prospective customer who is the sibling of a high-ranking minister or a known business consultant for a provincial governor, the risk profile must be elevated accordingly. Neglecting these secondary connections is one of the most common ways that illicit funds bypass standard screening protocols. Corruption risk is the primary driver behind the PEP designation, as these individuals often have direct control over public funds or the power to award government contracts. This access facilitates grand corruption, where massive sums of state money are diverted into private accounts. Because PEPs often influence the very regulatory or legal bodies that should be monitoring them, they can effectively shield their activities from local scrutiny. This reality necessitates the implementation of enhanced due diligence, or EDD, whenever a relationship with a PEP is established. The goal of EDD in this context is to create a comprehensive understanding of the customer's financial life that goes beyond simple identity verification. One of the most important regulatory requirements for handling PEPs involves the internal approval process. Unlike a standard retail customer account, which might be opened by a frontline staff member, the decision to onboard a PEP or to continue a relationship with an existing customer who becomes a PEP must be made by senior management. This ensures that the institution's leadership is aware of the high-risk exposure and accepts the potential legal and reputational consequences. Senior management approval is not a one-time formality, but a recurring necessity. If a person is promoted to a high-ranking government position during the course of an existing banking relationship, the compliance team must escalate the file to senior management for a fresh review and reapproval. In addition to management oversight, financial institutions must take proactive steps to establish the source of wealth and the source of funds for all PEPs. While source of funds refers to the specific origin of the money used in a particular transaction, source of wealth is a much broader concept that encompasses the entire body of assets the individual has accumulated over their lifetime. For a PEP, you must verify that their lifestyle and the volume of their transactions are commensurate with their official government salary and any known legitimate private business interests. If a government official earning a modest public salary attempts to deposit millions of dollars, the discrepancy should trigger an immediate investigation and potentially a suspicious activity report. The time frame for how long an individual remains a PEP after leaving office is a subject of ongoing debate and varies by jurisdiction, but the general principle is once a PEP, always a PEP, at least for a significant period. Even after a politician retires, their influence and the connections they built while in office can still be leveraged for corrupt purposes. Therefore, you should not automatically downgrade a customer's risk profile the moment they step down from a public role. A risk-based approach dictates that you should continue to treat them as a PEP until the specific risks associated with their former position have demonstrably faded. This level of continuous monitoring is what keeps the financial system resilient against the persistent threat of political corruption. I'll see you in the next lesson. Welcome back. Monitoring is not a static event that occurs only during the onboarding process. Rather, it is a continuous obligation that persists throughout the entire life cycle of the relationship. When we talk about ongoing customer monitoring, we are discussing the mechanism by which a financial institution ensures that its understanding of a customer remains current and relevant. The risk profile assigned at the inception of the account is merely a hypothesis based on stated intentions, and it is only through the observation of actual behavior that we can validate or adjust that hypothesis. If a customer claims they will only use an account for domestic utility payments but then begins receiving frequent international wire transfers from high-risk jurisdictions, the initial risk assessment is no longer accurate. This misalignment between expected and actual activity is the primary trigger for reevaluating the customer's risk rating and the overall level of scrutiny applied to the account. To maintain an effective monitoring strategy, an institution must employ a dynamic approach to refreshing documentation and data. High-risk customers usually require a more frequent refresh cycle, often annually, whereas low-risk customers might only be reviewed every 3 to 5 years. This periodic review is not just a checkbox exercise. It involves scrutinizing the customer's source of wealth, the nature of their business, and their counterparty relationships to see if anything fundamental has changed. For example, a corporate client might have undergone a change in ownership that introduces a new beneficial owner from a sanctioned region. Without a robust, ongoing monitoring process, such a significant change would go unnoticed until the next scheduled review, leaving the institution exposed to regulatory and reputational risks in the interim. Transaction monitoring systems serve as the technical backbone for observing behavior, but they must be calibrated to the specific risks inherent in each customer segment. These systems look for patterns that deviate from established norms, such as rapid movement of funds, structuring of cash deposits, or transactions that lack an obvious economic purpose. When a transaction alert is generated, it provides an opportunity to reassess whether the customer's profile is still appropriate or if the activity suggests a shift in their risk category. It is a common mistake to view transaction monitoring and profile reviews as separate silos, but in a mature AML program, they feed into one another. A series of unusual transactions should trigger an immediate out-of-cycle review of the customer's due diligence file to ensure that the documented risk profile reflects the current reality. Furthermore, ongoing monitoring must include a process for screening against updated watch lists and PEP databases. Since names are added to sanctions lists and political landscapes shift daily, a person who was not a politically exposed person yesterday might become one today after an election or appointment. An institution needs to ensure that its customer database is regularly cross-referenced against these external data sources to capture these changes in real time or near real time. If a customer is identified as a new match on a sanctions list, the monitoring process should immediately escalate the matter for potential account freezing or termination. This proactive stance is what differentiates a functioning compliance program from one that is merely reactive and therefore vulnerable to exploitation by money launderers. The ultimate goal of these combined efforts is to maintain an accurate, living record of the risk each customer poses to the organization. When the institution identifies a discrepancy between the recorded profile and the observed behavior, it must document these findings and adjust the risk score accordingly. This may result in the application of enhanced due diligence measures if the risk level increases, or it might lead to the filing of a suspicious activity report if the behavior cannot be logically explained. By treating the customer relationship as a dynamic variable rather than a fixed constant, the institution can better allocate its compliance resources to the areas of greatest concern. This continuous feedback loop between data collection, behavioral observation, and risk re-rating is the essence of effective ongoing customer monitoring. I hope this provides a clear framework for how you should view persistent oversight in a professional AML context. I look forward to seeing you in the next lecture. Welcome back. When we talk about economic sanctions screening, we are discussing a non-negotiable component of a modern AML framework that operates on a different legal logic than standard money laundering prevention. Money laundering involves concealing the origins of illicitly obtained money, while sanctions are about prohibiting transactions with specific individuals, entities, or countries regardless of where the money came from. As a compliance professional, you must view screening as a binary gatekeeping function designed to ensure that your institution does not become a conduit for prohibited geopolitical actors. This process starts at the onboarding stage, where every new customer is checked against various lists and continues through the entire life cycle of the relationship. It is not a one-time event, but a continuous obligation that must be integrated into the firm's technological stack. The most prominent authority in this space is the Office of Foreign Assets Control, or OFAC, which operates under the United States Department of the Treasury. Even if your institution is located outside the United States, you will likely need to screen against the specially designated nationals and block persons list because of the global reach of the US dollar. OFAC lists include individuals, groups like terrorist organizations, and entire regimes that are subject to comprehensive or sectoral sanctions. A match on this list usually requires an immediate freezing of assets and a rejection of the transaction, followed by a formal report to the Treasury. The legal consequences for failing to identify a match on the SDN list are often significantly more severe than a simple administrative fine for poor documentation. Beyond the United States, you must also consider the consolidated lists issued by the United Nations Security Council, which target threats to international peace and security. These UN lists are globally recognized and often form the basis for local legislation in member states across the world. Additionally, the European Union maintains its own consolidated list of persons, groups, and entities subject to EU financial sanctions. Depending on your jurisdiction and your customer base, you may also need to monitor lists from the United Kingdom's HM Treasury or various national watch lists. Integrating these diverse data sets requires a sophisticated matching engine that can handle variations in spelling, transliteration from different alphabets, and common aliases. The technical implementation of screening often relies on fuzzy matching algorithms to account for the fact that data is rarely perfect. Name variations, such as the use of middle names, titles, or phonetic misspellings, necessitate a system that can return potential matches based on a percentage of similarity. However, this introduces the persistent challenge of false positives, where a legitimate customer shares a name with a sanctioned individual. Your internal procedures must define a clear path for clearing these alerts through a comparison of secondary identifiers like date of birth, nationality, or permanent address. You cannot simply ignore an alert. Every hit must be systematically reviewed and documented to prove why it was determined to be a false positive. Existing customer databases must also be rescreened whenever a sanctions list is updated, which can happen daily or even several times a day in volatile geopolitical climates. Batch screening is the standard method for this, where the entire customer base is compared against the updated records to identify any new matches. If a long-standing customer is suddenly added to a sanctions list, the institution must be prepared to cease all activity immediately and potentially block their accounts. This real-time requirement means that your screening software must be robust enough to handle high volumes without disrupting the operational flow of the business. You must also ensure that the underlying data in your KYC files is accurate and up-to-date, as outdated information significantly increases the risk of missing a valid match. Finally, sanction screening extends beyond just the names of account holders to include the parties involved in wire transfers and trade finance transactions. In a cross-border payment, for example, your system must screen the originator, the beneficiary, and even the intermediary banks and shipping vessels. This illustrates why screening is a critical part of the broader customer due diligence process, as it serves as an automated firewall. If you fail to screen a counterparty in a transaction, you could inadvertently facilitate the financing of a prohibited program or entity, leading to massive regulatory penalties and reputational damage. Understanding the interplay between list management, fuzzy matching thresholds, and alert resolution is essential for any compliance officer preparing for the CAMS exam. See you in the next lecture. Welcome back. Let's solidify our knowledge with a short quiz regarding the due diligence concepts we have covered so far. An institution is conducting a periodic review of a corporate client and discovers that a new individual has acquired a 30% stake in the company. The individual is a close family member of a former cabinet minister from a jurisdiction known for high levels of public corruption. Which of the following actions should the institution prioritize according to international standards? A. Terminate the relationship immediately due to the high risk of corruption. B. Apply simplified due diligence because the individual is an immediate family member. C. Perform enhanced due diligence and verify the source of wealth and funds. D. Report the individual to the local law enforcement agency without further investigation. Please pause the video now and think about the answer before we continue. The correct answer is C. Perform enhanced due diligence and verify the source of wealth and funds. This question tests your understanding of three critical pillars in the customer due diligence process: ultimate beneficial ownership, the definition of a politically exposed person, and the application of enhanced due diligence. In most regulatory frameworks, an individual holding 25% or more of a legal entity is considered a beneficial owner, making this new 30% stakeholder a person of significant control. Because this individual is a close family member of a former high-ranking official, they meet the definition of a politically exposed person. While the person is no longer in office, the risk associated with their influence often remains, and global standards dictate that family members of such officials must be treated with the same level of scrutiny as the officials themselves. Option A is incorrect because having a politically exposed person as a beneficial owner is not an automatic ground for termination. Rather, it is a risk that must be managed through increased oversight. Option B is factually wrong because a family connection to a high-ranking official necessitates more scrutiny, not less, as the risk of money laundering through shells or family proxies is elevated. Option D is premature, as a suspicious activity report should only be filed when there is a concrete suspicion of illicit activity, whereas this situation simply calls for heightened due diligence. By conducting enhanced due diligence and verifying the source of wealth and funds, the institution adheres to the FATF recommendations for managing high-risk relationships. This ensures that the bank is not inadvertently facilitating the laundering of proceeds from public corruption. See you in the next lecture. Hello again. It is time to look at the practical mechanics of identifying suspicious activity within a financial institution. Recognizing suspicious activity is rarely about finding a single, smoking gun that proves a crime has been committed. Instead, it is a process of identifying anomalies and red flags that deviate from a customer's established profile or from the expected behavior of a specific peer group. In the context of the CAMS exam, you need to understand that a red flag is a warning signal that should prompt further inquiry, not necessarily an immediate conclusion of guilt. Effective identification begins with a robust baseline of what constitutes normal behavior for a particular client. If you do not know what the typical transaction volume or typical counterparty list looks like for a domestic retail business, you will have no framework for identifying when their cross-border activity suddenly spikes without any apparent business justification. This process requires a disciplined comparison between the observed reality of the transactions and the stated purpose of the account captured during the onboarding phase. One of the most frequent indicators of suspicious activity involves transaction patterns designed to evade reporting requirements, often referred to as structuring or smuffing. You will likely encounter scenarios where a customer makes multiple cash deposits just below a legal reporting threshold, such as $10,000 in the United States. While individual transactions may seem innocuous, the cumulative effect and the repetitive nature of the behavior suggest an intent to bypass regulatory scrutiny. Another common behavioral red flag is when a customer shows an unusual level of interest in the institution's internal reporting thresholds or specific AML policies. A legitimate customer generally focuses on the utility of the banking service, whereas a person attempting to launder money may ask leading questions about how the bank monitors transactions or what triggers a suspicious activity report. When a client becomes defensive or aggressive upon being asked routine questions about the source of funds, this should be noted as a significant behavioral anomaly that warrants an internal investigation. The movement of funds also provides critical clues, particularly when the flow of money lacks an obvious economic purpose or commercial rationale. For instance, you should be wary of round-trip transactions where funds are wired out to a foreign jurisdiction only to be wired back to the same person or entity shortly thereafter from a different source. This often indicates an attempt to obscure the origin of the funds by layering them through multiple accounts. Similarly, the use of multiple accounts to collect small deposits, which are then consolidated into one large outgoing wire transfer, is a classic red flag for the placement and layering phases of money laundering. You must also look for businesses that engage in transactions inconsistent with their stated industry, such as a local bakery suddenly receiving large payments for consulting services or electronics. These discrepancies between the business model and the actual financial flow are key indicators that the account may be used as a front for illicit proceeds. Geographic risk plays a central role in identifying suspicious activity, especially when transactions involve high-risk jurisdictions known for weak AML controls or high levels of corruption. If a customer who typically operates within a stable domestic market suddenly begins transferring large sums to an offshore financial center with no clear business link, the risk profile of that activity increases substantially. You also need to monitor activity involving jurisdictions that are subject to international sanctions or are identified by the FATF as having strategic deficiencies. It is not just about where the money is going, but also where it is coming from. Transactions involving shell companies or entities with opaque ownership structures located in these high-risk areas should be scrutinized with a higher level of skepticism. If the documentation provided to justify such transactions is vague, overly complex, or appears to be photocopied and altered, these are technical red flags that point toward potential fraud or laundering. In the digital age, behavioral anomalies also extend to how customers interact with the institution's technology. Frequent changes to account security settings, such as the registered phone number or email address, followed immediately by high-value transfers, can indicate account takeover or the use of a mule account. Furthermore, you should watch for customers who provide minimal or suspiciously consistent information across multiple unrelated accounts, which might suggest a coordinated criminal effort. In many cases, suspicious activity is identified not by a single large event, but by a series of small, related anomalies that, when viewed holistically, paint a picture of illicit intent. Your objective is to maintain a skeptical mindset and ensure that any activity that does not make sense from a business or personal perspective is flagged for a deeper dive. Consistent monitoring and a clear understanding of these red flags are what allow a compliance program to move from passive observation to active detection. I hope this helped clarify how we distinguish between routine banking and suspicious behavior. I will see you in the next lecture. Hello, and welcome back to the course. When we talk about managing internal investigations, we are discussing the bridge between a system alert and the eventual filing of a suspicious activity report. Once an alert is generated or a suspicious transaction is flagged by a frontline employee, the organization must follow a structured escalation process that removes ambiguity from the decision-making chain. You cannot simply leave an alert unaddressed. It must be assigned to an investigator who has the authority and independence to scrutinize the transaction without interference from a business line. This escalation typically begins with an initial review to determine if the activity is truly unusual or if it can be explained by the customer's known profile. If the activity remains suspicious, it moves into a formal investigation phase where the compliance department takes ownership. The goal here is to establish a rigorous workflow where every step is trackable and every decision is justified by hard data. The core of any internal investigation is the collection and analysis of information, which must be done in a methodical and comprehensive manner. You should begin by reviewing the customer's entire relationship with the institution, rather than looking at an isolated transaction in a vacuum. This involves examining account opening documents, previous transaction history, and any records of prior alerts or suspicious activity reports associated with that individual or entity. It is often helpful to search public records and negative media to see if the customer has been linked to criminal activity or regulatory sanctions elsewhere. You need to verify if the actual behavior matches the stated purpose of the account provided during the onboarding process. For instance, if a personal account suddenly receives large commercial wire transfers from high-risk jurisdictions, this represents a significant deviation that requires a deep dive into the source of funds and the nature of the underlying business. Documentation is perhaps the most critical component of the investigative process because it serves as the permanent record of the institution's diligence. If a regulator or law enforcement agency later audits your files, they should be able to follow your logic through the documentation alone without needing a verbal explanation. This means that for every investigation, you should maintain a case file that includes a timeline of events, copies of the analyzed transactions, and a narrative summary of your findings. You must document exactly why an investigation was opened, what specific steps were taken to verify the information, and why a specific conclusion was reached. Even if you decide not to file a suspicious activity report, the reasons for that decision must be clearly articulated and supported by the evidence found during the investigation. Failing to document why you cleared a suspicious alert is a common regulatory trap that often leads to significant fines. Maintaining strict confidentiality is a non-negotiable requirement throughout the entire duration of an internal investigation to prevent tipping off the subject. If a customer becomes aware that they are being investigated for money laundering, they might move their funds immediately or destroy evidence, which significantly hinders law enforcement efforts. Within the organization, information regarding the investigation should be shared strictly on a need-to-know basis, typically limited to the compliance team and legal counsel. You must ensure that internal systems do not inadvertently tip off the customer, such as through automated notifications or notes in a shared CRM system that a bank teller might accidentally mention to the client. This level of secrecy protects the integrity of the financial system and ensures that if a crime is being committed, the authorities have a chance to act before the perpetrators disappear. A thorough investigation also requires a systematic approach to identifying the ultimate beneficial owners and any third parties involved in the suspicious transactions. You're not just looking at the account holder, but at the entire web of connections that facilitate the movement of value. This might involve looking at the beneficiaries of outgoing wires or the origination points of incoming transfers to see if there's a pattern of layering intended to obscure the trail. If the customer is a legal entity, you must re-verify the ownership structure to ensure that no sanctioned individuals or politically exposed persons are behind the transactions. It is important to look for round-tripping, where funds go out to an offshore entity only to return as a supposed loan or investment. By mapping these connections, you move from merely observing data to understanding the actual intent behind the financial activity. Finally, once all evidence is gathered and analyzed, the investigator must finalize the findings and trigger the appropriate next steps. This often involves a final review by a senior compliance officer or a committee to ensure that the investigation met the institution's internal standards and regulatory requirements. If the investigation confirms suspicious activity, you must move quickly to the reporting phase. But if the activity is deemed legitimate, the case can be closed with a clear explanation. In some cases, the investigation might lead to a decision to terminate the customer relationship entirely to mitigate future risk. Regardless of the outcome, the internal investigation is a diagnostic tool that identifies where the organization might be exposed to criminal exploitation. It is a vital internal control that ensures the institution does not become an unwitting participant in financial crime. I hope this provided a clear framework for how these investigations should be structured and managed. I will see you in the next lecture. Hello, it is good to have you back for this discussion. The filing of a suspicious activity report, or SAR, represents the final and most critical output of an institution's investigative process. When we talk about reporting, we are not merely performing a bureaucratic task. We are providing actionable intelligence to law enforcement agencies tasked with protecting the financial system. The regulatory requirement generally mandates that once an institution determines a transaction is suspicious, It must file a report within a specific time frame, often 30 days. This clock usually starts ticking from a moment the suspicion is identified, not necessarily from the date the transaction occurred. Failing to meet these deadlines can lead to significant regulatory penalties, as the utility of the information diminishes rapidly over time. It is vital to understand that the report must be filed even if the underlying criminal activity has not been definitively proven by the institution. A well-drafted SAR serves as a narrative evidence chain that should be clear, concise, and logically organized. You should avoid using overly technical jargon or internal shorthand that an outside investigator might find confusing. Instead, focus on the 5 essential questions: who, what, when, where, and why. The why is particularly important because it outlines the specific reasons the institution found the activity suspicious. You might describe how a customer's behavior deviated from their established profile or how the transactions lacked an obvious economic purpose. Providing a chronological structure helps the reader understand the progression of events without having to piece together a puzzle. The narrative section is perhaps the most scrutinized part of the report by both regulators and law enforcement. You must ensure that the description of the activity is granular enough to be useful, but concise enough to remain readable. Start with a brief summary of the activity, then move into a detailed breakdown of the specific transactions, including dates, amounts, and account numbers. It is beneficial to explain the source of funds and the ultimate destination of those funds whenever possible. If the investigation involved multiple accounts or entities, a clear explanation of the relationships between them is necessary. Remember that the goal is to enable a law enforcement officer to quickly grasp the nature of the potential crime. Maintaining the confidentiality of the SAR is a fundamental legal requirement that you must respect at all times. Under tipping-off provisions, it is strictly prohibited to disclose to the subject of the report or to any unauthorized third party that a SAR has been filed or is being considered. This protection exists to prevent subjects from destroying evidence or fleeing before authorities can act. Institutions must have robust internal controls to ensure that the existence of a SAR is known only to those with a direct need to know within the compliance and legal functions. Even during the course of regular business, or if a customer asks why their account is being closed, the compliance officer must ensure that no hint of the reporting status is revealed. Best practices for reporting also involve proper documentation and record keeping after the filing is complete. You are required to maintain a copy of the filed SAR and all supporting documentation for a specific period, typically 5 years in many jurisdictions. Supporting documentation includes items such as account statements, wire transfer records, and copies of identification documents that were reviewed during the investigation. While these documents are not usually filed with the SAR itself, they must be readily available if law enforcement requests them through a subpoena. The record-keeping process ensures that the institution can demonstrate its compliance with the law if audited by regulators. Another critical aspect of the reporting process is the decision-making regarding whether to keep the customer relationship open. Filing an SAR does not automatically require you to close an account, but it should trigger a review of the customer's risk rating. If the institution decides to maintain the account, it must document the rationale and implement enhanced monitoring to mitigate the ongoing risk. In some cases, law enforcement might even request that an account remain open to facilitate an ongoing investigation, a situation often referred to as a keep open request. Such requests should ideally be obtained in writing to provide the institution with a layer of regulatory protection for continuing a high-risk relationship. Finally, the quality of your reporting can be improved by establishing a consistent internal review process. Before a SAR is submitted, it is often helpful to have a second set of eyes review the narrative for clarity and accuracy. This quality assurance step helps catch errors in transaction amounts or dates that could undermine the report's credibility. Consistency in how your institution describes certain types of red flags, such as structuring or funnel account activity, also helps law enforcement identify patterns across different filings. By following these disciplined reporting standards, the compliance function ensures it meets its legal obligations while providing maximum value to the global effort against financial crime. I hope this provides a clear framework for your reporting duties. Until the next time, hello. It is good to have you back for this discussion on the intersection of institutional compliance and criminal justice. When a financial institution receives a request from law enforcement, the interaction moves beyond internal monitoring and into the realm of legal obligation and jurisdictional complexity. You must understand that while your primary duty is to your institution's regulatory standing, you also function as an essential node in the broader infrastructure of public safety. Effectively cooperating with law enforcement during multi-jurisdictional investigations requires a structured protocol that balances transparency with a strict adherence to privacy laws. In most cases, these requests are triggered after a suspicious activity report has flagged a specific pattern, but they can also arrive as part of a larger, external investigation where your institution holds a piece of the puzzle. You should treat every request as an official legal process that requires a centralized point of contact, typically the anti-money laundering officer or a designated legal counsel. This centralization ensures that the information provided is accurate, documented, and delivered within the scope of the specific request without providing unnecessary data that could complicate the investigation or violate customer rights. Managing requests becomes significantly more complex when an investigation crosses international borders, involving multiple agencies with overlapping or even conflicting legal frameworks. In these scenarios, communication protocols must be even more rigorous to ensure that information sharing does not violate the data protection laws of one country while trying to satisfy the criminal subpoenas of another. You will often encounter situations where a domestic law enforcement agency is acting on behalf of a foreign government through a mutual legal assistance treaty or a similar international cooperation agreement. It is your responsibility to verify the legitimacy of these requests by ensuring they have been funneled through the appropriate domestic, judicial, or regulatory channels. Never assume that a request from a foreign entity is immediately enforceable without domestic validation, as doing so might expose the institution to significant liability and litigation. By maintaining a professional and cooperative stance while insisting on proper legal documentation, you protect the institution while providing law enforcement with the high-quality evidence they need to pursue complex financial crimes. One of the most critical aspects of this cooperation is the principle of non-disclosure, often referred to in various jurisdictions as the prohibition against tipping off. When law enforcement is conducting an active investigation, the existence of their request must remain strictly confidential within a narrow circle of necessary personnel inside the financial institution. If a customer or an unauthorized employee becomes aware of the investigation, the entire operation could be compromised, allowing criminals to move assets or destroy evidence before the authorities can intervene. This requires clear internal communication policies that dictate how such requests are handled and where the physical or digital files are stored. You must ensure that the records provided to law enforcement are organized, legible, and accompanied by the necessary certifications to be admissible in court. Providing a disorganized mass of data is not only unhelpful, but can also signal a lack of internal control, which might lead law enforcement or regulators to scrutinize your institution's overall AML program effectiveness. Finally, you should recognize that cooperation with law enforcement is not merely a reactive process, but a strategic partnership designed to mitigate systemic risk. When investigators request information about complex transactions, they may also seek your expertise in interpreting the data, as your team understands the specific nuances of your bank's products and typical customer behavior better than an outside agent. However, while being helpful is encouraged, you must remain mindful of the boundaries defined by the specific legal instruments served. whether it is a subpoena, a search warrant, or an administrative request. Always document every interaction with law enforcement, including the names of the agents, the date of the request, and the specific documents provided to maintain a clear audit trail. This documentation is vital for demonstrating your institution's compliance with the law during future regulatory examinations or internal audits. In the end, a successful relationship with law enforcement is built on the pillars of procedural integrity, timely responses, and a deep understanding of the legal frameworks that govern financial data sharing. I hope this provides a clear framework for handling these sensitive interactions, and I look forward to continuing. Hello, and welcome back to the course. When a financial institution receives a subpoena, it is facing a legal demand for information issued by a court or government agency. You should understand that a subpoena is not a suggestion, but a formal instruction to produce specific documents or provide testimony. Upon receipt, the institution must immediately notify its legal counsel and the compliance officer to ensure the response remains within the boundaries of the law. The institution should not treat this as an adversarial process, but rather as a procedural requirement that must be handled with precision. A critical step is to ensure that the required records are preserved and that no documents related to the request are destroyed or altered. If the subpoena is overly broad or places an undue burden on the institution, the legal department may attempt to narrow its scope through negotiation with the issuing authority. However, until such time as the scope is formally changed, the institution must remain prepared to fulfill the original request. The management of records during a subpoena process requires a systematic approach to document retention and cataloging. You must ensure that the institution identifies all relevant files, which may include account opening documents, transaction logs, and internal communications. Providing incomplete data can lead to legal sanctions, so it is necessary to maintain a clear log of what was handed over and when the delivery occurred. It is also important to note that while the institution is complying with the government's request, it must still be mindful of privacy laws. In many jurisdictions, the institution is prohibited from notifying the customer that their records have been requested, especially in the context of criminal investigations. This concept, often referred to as avoiding a tip-off, is a fundamental requirement in maintaining the integrity of the ongoing investigation. The compliance officer should ensure that internal communication regarding the subpoena is strictly limited to those with a genuine need to know. A search warrant represents a more intrusive and immediate action compared to a subpoena, as it allows law enforcement to enter the premises and seize property. Unlike a subpoena, which allows for a period of time to gather and review documents, a search warrant is executed on the spot. When agents arrive with a warrant, the staff should remain calm and ask to see the credentials of the lead agent and a copy of the warrant itself. It is not the role of the bank staff to obstruct the search, but they should certainly observe the process and take detailed notes on what is being seized. If possible, a dedicated staff member should be assigned to follow the agents and record the specific areas searched and the items removed. The institution's legal counsel should be contacted immediately, though the search will likely begin before counsel arrives on site. During the execution of a search warrant, the institution should request a copy of the inventory list prepared by the seizing officers before they leave the premises. This receipt is the primary record of what has been taken and is vital for the institution to understand the extent of the investigation. While the agents have the right to seize physical items or digital data as specified in the warrant, they do not have the right to interview employees without their consent. Employees should be informed that they have the right to consult with an attorney before answering any questions from law enforcement. The compliance department must also evaluate whether the items seized or the facts surrounding the search warrant necessitate the filing of a suspicious activity report. Even if a report has been filed previously, the execution of a search warrant is a significant event that should trigger a review of the internal investigation file. Handling these legal requests properly is a matter of integrating legal awareness with operational discipline. You must ensure that the institution does not overstep its bounds by providing more than what is requested, but it must also not provide less. Proper documentation of every step in the process protects the institution from future claims of negligence or noncompliance. Ultimately, the goal is to cooperate with the authorities in a way that is structured, documented, and legally sound. This requires a clear internal policy that outlines exactly who is responsible for receiving and processing such orders. Without a standardized procedure, an institution risks making errors that could lead to fines or reputational damage. I'll see you in the next lesson. Welcome back. When we discuss anti-money laundering investigations, we eventually hit a wall defined by national sovereignty. Financial criminals do not respect borders, yet the legal authority of a single domestic investigator stops exactly at the edge of their jurisdiction. To bridge this gap, the international community has developed structured frameworks that allow for the exchange of evidence and intelligence between nations. You must understand that these frameworks are not monolithic. They serve different purposes depending on whether the information is intended for use in an active courtroom or as preliminary intelligence to guide a budding investigation. We primarily look at mutual legal assistance treaties and the cooperation between financial intelligence units as the two pillars of this cooperation. Mutual legal assistance treaties, or MLATs, represent the most formal and rigorous mechanism for international cooperation in criminal matters. These are essentially agreements between two or more countries that establish a legal basis for one state to provide evidence or assistance to another. Because these treaties are grounded in international law, the information obtained through an MLAT is typically admissible in a court of law. This might include anything from the taking of testimony under oath to the execution of search warrants or the seizure of assets located in a foreign jurisdiction. However, the process is notoriously slow because it moves through central authorities, usually ministries of justice or state departments, ensuring that all constitutional protections and treaty obligations are met. A critical concept you will encounter regarding MLATs and international cooperation is dual criminality. This principle dictates that the act for which assistance is sought must be a crime in both the requesting and the requested countries. If a country is asked to help investigate an activity that is perfectly legal under its own laws, it may refuse the request. While the Financial Action Task Force has pushed for countries to be more flexible here, dual criminality remains a primary hurdle in the MLAT process. You should view the MLAT as the heavy machinery of international sharing. It is powerful and provides high-quality evidence, but it requires significant time and high legal thresholds to operate. While MLATs handle the judicial side, financial intelligence units, or FIUs, handle the operational intelligence side through much more agile channels. Most FIUs around the world belong to the Egmont Group, which is a body that facilitates the secure exchange of information to combat money laundering and terrorist financing. Unlike the formal MLAT process, FIU to FIU communication is often informal in the sense that it happens outside the courtroom. An investigator in one country can ask their local FIU to reach out to a foreign FIU to see if a particular subject has any reported activity or bank accounts in that region. This allows for rapid verification of leads before committing to the long and expensive process of an MLAT. The exchange of information between FIUs is governed by strict principles to ensure that the data is not misused. Information provided by one FIU to another is generally intended for lead-building purposes only and cannot be used as evidence in a trial without the express consent of the providing country. This is a common point of confusion, so you must keep this distinction clear. FIU sharing is for intelligence, while MLATs are for evidence. If an investigator receives a hit from a foreign FIU, they use that knowledge to refine their investigation and then follow up with an MLAT request to get the actual documents they need for prosecution. This two-step approach ensures that the formal channels are not clogged with vague or speculative requests. Beyond these bilateral and multilateral agreements, there are also international organizations that provide the infrastructure for communication. Interpol and Europol are perhaps the most famous, offering secure communication networks and databases for law enforcement to track fugitives and criminal trends. These organizations do not have their own investigative powers inside your country, but they act as a clearinghouse for information that might otherwise stay siloed. For the CAMS exam, you should appreciate that effective international cooperation requires a mixture of these formal legal treaties and the informal intelligence networks. Successful investigations almost always start with a quick FIU query and conclude with a formal MLAT request. I hope this clarifies how investigative information crosses borders. See you in the next lecture. Hello, I'm glad you are back to test your knowledge on the practical aspects of financial investigations. Let's see if we can solidify what we have learned so far with a few targeted questions. Question 1. When a financial institution is served with a search warrant by a law enforcement agency, what is the most appropriate first step for the investigator or compliance officer? A. Immediately freeze all accounts of the subjects listed in the warrant. B. Verify that the warrant is signed by a judicial officer and is currently valid. C. Contact the customer to inform them that their records are being seized. D. Shred any documents that might potentially incriminate the institution itself. Question 2. A suspicious activity report, SAR, must generally be filed within how many days of the initial detection of a suspicious pattern, assuming the suspect has been identified? A. 15 days. B. 30 days. C. 60 days. D. 90 days. Please pause the video now and take a moment to consider which answers are correct based on the standards we have discussed. The correct answer for question 1 is B, to verify that the warrant is signed by a judicial officer and is currently valid. The correct answer for question 2 is B, 30 days. The rationale for the first question centers on the legal nature of search warrants, which are intrusive and require specific judicial oversight. You must ensure the warrant is legally binding before complying, as providing data without a valid warrant could result in privacy violations or legal repercussions for the institution. Freezing accounts is not an automatic requirement unless a separate seizure order is provided, and tipping off the customer is strictly prohibited by anti-money laundering laws. Cooperation with law enforcement is necessary, but must be predicated on a legally sound request that adheres to the procedural requirements of the jurisdiction. Regarding the second question, the 30-day timeline is a global benchmark often cited in the CAMS environment, though some jurisdictions may vary slightly for unidentified suspects. If a suspect is identified, the clock typically starts at the moment the activity is deemed suspicious by the Internal Investigation Committee, not necessarily the moment the transaction occurred. This ensures that the financial intelligence units receive timely information to act upon while giving the institution enough time to conduct a thorough internal review. Accuracy and timeliness are equally important, but for the purpose of the exam, the 30-day window is the standard you need to remember. I hope these explanations help clarify how the theoretical standard apply to these specific investigative scenarios. See you in the next lecture. Hello again. It is time to consolidate what we have discussed and prepare for the actual examination environment. You have now navigated through the technical architecture of anti-money laundering, from the 3 stages of the laundering cycle to the complex regulatory frameworks established by the FATF and the European Union. Success on the CAMS exam requires more than just memorizing these facts. It requires the ability to apply the risk-based approach to specific, often ambiguous scenarios. We have looked at how correspondent banking and non-bank financial institutions are exploited and how an effective compliance program acts as a defensive layer through independent audits and robust training. This body of knowledge forms the foundation of your professional practice. But the exam itself is a different kind of challenge that demands a strategic mindset and disciplined time management. The CAMS exam is composed of multiple choice and multiple select questions, which often present scenario-based problems. One of the most effective strategies is to identify the specific persona being addressed in the question, whether it is the board of directors, the compliance officer, or a frontline employee. By narrowing down the perspective, you can often eliminate choices that, while factually true in a general sense, do not answer the specific requirements of the role described. You should remain vigilant for qualifiers like most likely, first, or best, as these words signal that you are being asked to prioritize one correct action over several other plausible actions. This mirrors real-world compliance work, where resources are finite and a risk-based prioritization is the only sustainable way to operate. Managing your time during the session is as critical as your understanding of the Wolfsberg principles or the Basel Committee standards. You should aim to move through the questions at a steady pace, marking those that require deeper analysis for a second pass rather than stalling on a single difficult item. On your first pass, answer everything you are certain about to build momentum and ensure you have captured all the low-hanging fruit. When you return to the flag questions, look for keywords that link back to the core principles we discussed, such as transparency, beneficial ownership, or the suspicious activity reporting threshold. Often, the context provided in one question might inadvertently provide a hint or a memory trigger for another question located elsewhere in the exam. When you encounter questions regarding international cooperation or law enforcement requests, remember the emphasis we placed on the global nature of financial crime. The exam frequently tests your understanding of how information flows between jurisdictions through mechanisms like mutual legal assistance treaties or the Egmont Group of financial intelligence units. Always look for the answer that promotes the highest level of transparency and international cooperation without violating local tipping-off laws. It is also important to maintain a strict adherence to the internal hierarchy of an AML program. If a question asks about the final approval of a policy or an enterprise-wide risk assessment, the answer typically points towards senior management or the board, reinforcing the concept that a culture of compliance must be driven from the top down. Finally, ensure that you are comfortable with the nuances of customer due diligence, particularly when dealing with politically exposed persons and high-risk jurisdictions. The distinction between simplified, standard, and enhanced due diligence is a recurring theme that tests your ability to calibrate controls to the level of identified risk. If a scenario involves a sudden change in transaction patterns or a series of complex, non-logical transfers, your default mindset should be one of skepticism and investigation. By maintaining this analytical rigor and applying the structured framework we have built throughout this course, you'll be well positioned to navigate the complexities of the exam. Trust in the systematic approach we have taken to reach this point. I wish you the best of luck with your exam and your future career in AML. Goodbye.